Well, howdy, folks. It's Mike again. This is going to be interesting. Most likely a train wreck, but we will see. We'll try to keep this train going down these tracks. So, we are finally going to touch on volume. As many of you know, I look at volume as dirty data. Like some of you say that I don't think is relevant. You're full of it. I've never said it's not relevant. It's extremely relevant, extremely important. Something I wish I could use in my analysis because I used it for the vast majority of my career. But over the last, I don't know, decade, I've gotten more and more away from it to the point where over the last several years, I don't even look at it at all. Maybe the last 5 years, I don't even look at it at all. And people keep on asking why. And I keep saying, well, at first I was saying it's like a long topic. It's maybe an hour long. And then I started thinking about it. I'm like, no, that's 2 hours long. And I started thinking about it some more. And I was like, no, that's like 6 hours long. And I was thinking about it. I'm like, I don't think I could ever teach this of what's in my head of why I think the volume is dirty. And so I thought, how in the world am I going to express this to people? Because I'm trying to help folks. I mean, that's what this channel is about, is trying to help folks. And so if I just say it's dirty, but I don't tell you my thinking, it doesn't do any good, right? So I'm going to try to get through a series on volume. And I'm going to call it this volume 1 of dirty volume because I think that's funny. So this would be volume 1. I have no idea how many volumes we're going to have. And what the plan is to record a bunch of these and, a bunch of volumes of dirty volume. And then when I get the chance, I'm going to go through and edit all I'm going to release them one at a time as I record them, but then I will go through and edit it down as much as it can. So then it's just one volume or maybe 2 volumes. Cause this could be like, I don't know. I have no idea because as we go through this, you're going to see how many different things it touches on and how this is just this big onion of a problem. It's like you start peeling it back and then it's like more and more and more problems. And like I said, I don't use it at all. And I used to use it religiously. I built indicators and things just for Bill and I to use specifically for volume that we never released to anybody. It's pretty much just the two of us that were using it. So I take volume very seriously. And it was very important. Well, it is very important. It's just that I don't think you can get a read on dirty data. So I will try to, again, I'm going to do these in a normal rambling fashion because I was going to plan this out and have all these talking points in an order, but I've never done that for any of these. If you haven't figured it out, it's all off the cuff, and I go where my mind just thinks at the time because I've got a full-time gig and I've got a lot going on in my life, so I don't really have time. I don't have time to do these, but I love doing them. And I want to continue putting one of these out a week. And if I start planning for it, then I don't have the time for that. So this is going to be another rambling episode. And I figured that was the only way I could get through this volume. So if you are hardcore and rigid in your thought process and you don't have an open mind, I'm sorry for you. You should probably rethink that. But if that's you, stop watching now. Do not put in the comments below, Mike is crazy because he doesn't think volume is accurate data and it's so important. And we know this because Bill said this and Livermore said that, or no, not really. But like all of the other ones, I mean, you go back to, the very beginning of technical analysis and how important volume is because it's confirmation, right? I mean, if you don't understand, I guess I can't assume knowledge. Volume is important. It's just dirty. So if you want to use dirty data, like, would you want to eat, like, if you dropped your food on the floor and the floor is dirty, well, if I drop food on the floor, I don't care how clean it is, I'm not eating it. But if you drop food on the floor and the floor is dirty, are you going to want to eat that? I don't think so. So why would you use something that's dirty? I just don't, I don't get it. Yes, I'm a little OCD or a lot OCD, but it's not that. It's about having accurate information. And as we go through this series, you'll get to understand that. And even if you still use volume when we're done with this, I kind of fathom that. But if you still use it, at least you might pick up on some other things that are important. What is volume? Volume is the number of shares that are traded on an instrument, right? So the price, you got the open, high, low, and close. The only thing you truly know, you've got all the fundamentals, which you pretty much know those, but you remember Enron and others like that. So you can't always trust it, but the vast, vast, vast majority of the times you can. There's questionable fundamental data with once you start getting into non-GAAP numbers and things, but still, as long as you're using apples with apples and your comparison to stocks, there's, I don't really have a problem with fundamental data. I lean heavier on sales than I do on earnings because earnings can be manipulated to a certain extent. Sales is really, really hard unless you're doing kind of fraud type of stuff. So what do we know? We know we'll just say fundamental information is accurate. So fundamental information is accurate. Price information is deadly accurate. I mean, unless your data source is got some bugs in it, which they all do, but like primarily where the open, high, low, and close are on any given instrument during a day, on any given day. But the volume, do you really know that number? No, you don't. You don't know what the true volume number is from the concept of what volume is. So let's go over the concept. So the concept of volume is that it's confirming the price action. So let's say the stock breaks out of a base and goes up 10% in a day. Well, the old thought process, traditional thought process, everyone's thought process except for mine is that you don't really trust that unless the volume is confirming that price action. And so I'll just give you a little hint. These days, go look for a stock that went up 10% on a day, unless it's a high ATR that's a normal day. But let's just say it's a stock that trades on average 3% a day up and down, and it's up 10%. Find me one on a full trading day where that move happened throughout the day and that volume isn't extremely high. Go have fun. Yeah, you'll find a few, but it'll probably be like, I'm not talking like going into a holiday weekend or the thing moved in the last 5 minutes or something. You're going to have volume move along with price these days. That wasn't always the case. So back in the day, and I'm talking before I was born, the concept was you can get a lot of false moves in the market and that stock goes up a whole bunch. But unless you have that real buying demand there, it's not going to stay up there because all it would be the market makers moving away from not wanting to get stuck with those shares. So they just keep on raising the offer. Well, just again, I don't want to assume any basic knowledge. So that's why this is going to be so long. When you're buying a stock, there's a bid and an ask, right? So the ask is what you're going to pay for it, and the bid is what you're going to sell it for. So the difference is the spread. So let's say the bid is 51 and the ask is 51 and a half. Meaning if you put a market order in for the amount of shares that are being offered there, that's another topic, but you're going to get 51 and a half or better, but you're going to get 51 and a half if you're going to buy it. And then to sell it, and that's taking the ask or you're taking the offer, same thing. And then the bid is where you would sell it. That's in that case 51. So a 50-cent spread. And so that's where you would, you just sell a market order, goes down, and it hits that, then that's what you're looking at. So the spread, the difference, that 50 cents in this example is your cost for that transaction. So let's think through that. You go in and you want to buy the stock, you pay 51 and a half. All of a sudden the market does something funky, the stock does something, or you want to turn around and sell it. Well, now you've hit the bid, and that spread, that's your cost. And then on top of that, you've got commissions back in the day. So that would really have someone go in there and say, oh, I really want to pay this, because a 50-cent spread back in the day was kind of a good spread. Like sometimes they were a buck or so. And even on lower price stocks, the $30s and $40 stocks with a buck spread was not unusual at all. And some spreads would be even bigger, meaning the true cost to buy that is not what the price is, it's the price that you can get on the way in and the price that you can get on the way out. Now, if you're dealing with size, then that's even a bigger problem. We will get into all of these in the episodes, but I'm just trying at the most basic level. Let's just kind of think through this. The volume is, in theory, confirming that price action because there was a cost associated with that transaction. Now, in a nutshell, there is no cost now relative to back then. There's still always a little slippage, right? So let's say, unless you're dealing with something very thin, the difference between the bid and the ask, right? It's not going to be 51 to 51 and a half. It's going to be maybe 51.45 or 51.49 by 51 and a half. So your spread is going to be tiny. So meaning you could just go in and buy it at the market and get that 51 and a half and then go, oh, that was a mistake. Let me sell it. And you get 51.49 or 51.48. And in that case, you've got this time, and now there's no commission in most cases, right? There are some brokers that do charge commission, and I do trade through one of those because it has some bells and whistles. That's an Interactive Broker that I choose to go with that and have a tiny little commission. But back in the day, commissions were a big deal, and the spreads were a big deal. And you don't have that now unless you're trading. Well, we won't get into it. This is where I'm really trying to stay as focused as I can. But the whole problem with this is once you start thinking or talking about one thing, it goes off into all these different elements. So let's kind of summarize what we have, the knowledge that we have so far. When you go in to buy a stock, you are going to, at the market, you're going to be paying the ask or the offer, same thing. And then to turn around and sell it, you're going to sell at the bid. Now, your broker might give you a better price in there, but that's the price that that's your kind of default, the bid and the ask. And the difference there is your true cost, because if you go in, you buy it, you turn around and sell it, whatever you lost in there, that is your cost, really excluding any of the market movement. So just thinking instantaneously, you buy it and you turn around and sell it. What does that cost you? And then we'll assume that there is no commission for now. So that is because for most people, you don't pay commission. The vast majority of folks don't pay commission. So now you have this tiny little true cost. So if you're going to go in there and just buy something, well, it's no big deal. You don't really think through it. But back in the day, you are really making a commitment, because if you're going to go in there and let's just say that we'll just label it for now as a transaction cost, meaning the slippage, the spread, and the commission. So slippage, oh God, I'm going to have to jot down notes of like things to make sure that we circle back to either in this volume or another one. So slippage. Shoot. I'm just going to tell you, I don't want a freaking notepad here of stuff. So as I think of it, I'm just going to talk about it. So slippage is the reality of the marketplace if you're doing any type of size. So if you're just going in buying 100 or 200 shares or an odd lot or something like that, you don't really deal with slippage unless, okay, I'm back. I had some sort of computer issue. So we were talking about slippage. So if you're dealing with any size, right, and that's what we're thinking of too, when we're looking at volume and a lot of confirmation of volume, any size that you're going in, let's say you're going to buy 10,000 shares of something. Well, you're not going to get the offer price, because if you do get the offer price, you don't want it. Trust me. So let's say again, it's let's do it. It's trading 5140 by 5150, meaning 5140 on the bid. That's where you can sell it, and it's a 10-cent spread, meaning that the difference between the two is 10 cents. So 5140 to sell, 5150 to buy. So now you've got 10,000 shares that you want to buy, which is a normal thing for anyone dealing with any size, any institutional orders or whatever. So now you're going in there, and you've got to figure out how can you get as close to 5150 as possible. So you start buying it, and maybe buy 500 shares of 5150, and then it stays there. Then you go and you buy another 500 shares, and now it stays there. And you're like, oh, this is pretty cool. Then now you're done on 1,000 of those 10,000 shares. Now you go in and you buy another, let's say 300 shares, because you don't want them to know that it's you. And if you're going in there 500, 500, 500, that's obvious that it's you. You're trying. It's a big poker game, right? So you're not trying to share your hand with anybody. So now you go in and buy another 300. Well, what do the market makers do? Well, most likely, all things being equal, they raise that. And now they could either open the spread up by bringing the 5140 down lower, or they raise the 5150 up higher. So let's think through this in both ways, that now your true cost is increasing. Either way they do it, and they could do it in both directions. They could open up the spread, and this is what happens in a fast-moving market, because you can think there's someone on the other side, right? A computer or a person, a market maker, and they don't want to get hosed, and they see all this buying pressure coming in with these orders. Then they can get the sense of that and then lift it, right? So that what they will just think of this in segments. Let's keep the spread the same. 10-cent spread, 5140 by 5150. Now they see this buying pressure going in there, and they're making the difference between the two, right? Because if they sell it to you for 5150, then and they're buying it from somebody else at 5140, they're pocketing the difference. Now, they're not always pocketing the difference, because they're not always going to get that full spread. That's a risk that they're taking on. So they sit there and go, okay, buying pressure coming in, let me lift the ask. So then they go, okay, well, we're going to go from 5150 to 5155. And they're going to raise the bid up there by a nickel as well. So they're going to nickel up. So you still have a 10-cent spread. Don't worry if you're getting confused. We'll fix this. So now it's going up a nickel, because they see this buying pressure in there. So now it's 5145 by 5155. And you've only done 1,300 shares. Now you've got, another 8,700 shares to do. You're like, shoot, this is getting away from me. Let me do a bigger order. Let me go in and put 700 shares in and see if I can get that. And they do 100 there. They fill 100 of that at 5155, and then they raise that offer up another nickel. Now they go up to 5160. But they keep, in this case, they say, yeah, there's someone in there. I don't want to get hosed, and so I'm going to keep the bid at 5145. So now the spread has gone up to 15 cents, right? And as that order is getting worked, now this order is in isolation. There's other buyers, and there's buyers who see this going on, and then maybe they're jumping in as well, or the market's moving as well. And so that is going to magnify this. But let's just forget about all that. This is just your order right now that we're talking about. So now we've gone through and we've done 2,000 shares. We leaves 8,000, and this is it's moving now. So now it's all the way up to 5175 by 5150. So now it's a quarter spread. And this is how it used to work. Like, this is exactly how it used to work. So now it's a quarter spread. Started off as a dime spread, and now it's a quarter spread, and you are still not done. You've got 8,000 more to do it. Maybe you're getting scared and you just say, just let me call the desk. And this is back in the day. Maybe you work that order through like a block desk or something like that. We're not going to talk about that today, because that's that onion. It's a whole different thing. So let's just say you're still working this order yourself. So now maybe you go and sit on the bid right now, because that's how you can become the market maker, right? So to speak. So it's 5150 by 5175. So now in the decimalization time frame, because we'll have to talk about the whole going from fractions to decimals, maybe in a different episode, but that impacts us too. So we've got you go on the inside bid. So now you're at 5151, because you've improved it a little bit, because you're jumping in front, because if someone wants to sell their shares at the market, you want to be the first in line to get that. So now you're at 5151 by 5175. So you're sitting on the bid, and maybe you're only showing 100 shares there, but behind it, you've got 5,000 shares. So if someone hits the bid with size, even though there's 100 shares showing, meaning if people were looking at the data, which let's call it level 2, which the level 2 back in the day, you used to have all the bids, because there's not just a bid there at 51 and a half or 5151. There's a bid there at 5151, 5150, 5149, 5148, and so on. And there's different amounts at each of these levels, and people are looking at that. Same thing with above it, right? We're at 5175 asking, right? There's 5176, 5177, and so on. So it's not just one level. When you see the normal quote, you're just looking at the best level. So you've got the spread, you've got the levels, you got the size there. And now I'm on the buy side, and I'm going, man, this thing is getting away from me. I'm sitting on the inside bid, meaning you went to 5151 with that 100 shares. Someone hits that, meaning sells it to you, and they sell 100 shares, and now it's executed at 51. I know this is complicated at first, but you'll go back and maybe jot this down, and the people who have been trading a long time, you get where I'm going. If you're newer, you're confused as heck. I would be confused as heck, but trust me, we'll get there. So you're sitting on the inside bid at 5151, and you've got 5,000 shares behind that is hidden, that people aren't seeing, and you're showing 100 shares there, and someone doesn't realize that there's buying pressure, or maybe they've been waiting for the buying pressure and they want to sell into that. So they hit you at the 51 for 100 shares. And so now you've absorbed that, right? So now you've got 2,100 shares done, right? And you're working the rest. What do you leave? 7,900. Now you're sitting there and you're still showing that 100, and they know that. This is a big poker game. They know that, but they don't know how much size is behind it. So someone's like, let me see how much size is there. Let me hit it for 2,000 shares. And so now they go down and they hit you for 2,000 shares, and then they get done on the whole thing. And they're like, oh, wow, there's a buyer in there. And everyone else sees that because they're looking at time and sales. So back in the day, not back in the day, that you still have it. You would have all those transactions, or all those bids and offers, as I was talking about, not just the inside, the best bid and offer. You've got all the ones behind it. And then separately, you're looking at the time and sales, meaning, okay, how many shares were executed and at what price? And that's a tape reader. That's what you do. That's what I used to do all the time, religiously. I had a huge edge doing that because I got very good at it. I'm just being honest, really good at it. It has worked with my personality to be able to understand the level two and how that worked. And I wasn't day trading, but this is just when you were dealing with size in a concentrated account, you had to understand that. And okay, so now we've done what we've done. Let's say we've done a few more now. Let's just say we've been able to pick up 5,000 shares, right? So we've done 5,000 shares, leaves 5,000, but because everyone has seen that those shares had hit at 51.51 with the 2,000 shares got executed there, even though 100 shares were being offered, everyone else knows, wow, there's a buyer in there, so I'm going to jump in front of this person. So you were at 51.51 and they jump in at 51.52 and someone else goes, oh, I know what game is going on there. So they go, no, I'm going to go up a few more cents. I'm going to go up to 51.55 on the bid side. At the same time that this is happening, the spread was a quarter, right? Because it was 51.50 by 51.75. That keeps on increasing. So now the ask is increasing as well as the bid going up. Now this stock is moving up, and those are real transactions that are going on there. But a lot of that, like your transactions, you're really wanting to buy this. But a lot of these other players that are in there, they're just trying to make the spread, right? They're trying to sell it to you at the 51.75 and then buy it from people at the 51.51. But now we're all the way up to, let's say this has been going on for a while. Let's say now that the bid is 51.75, offering 52. So it's moved all the way up there. This is normal. And you still have your quarter spread. So if you want to just buy at the market, you can buy your 100 shares at 52 and you can sell it your 100 shares at 51.75, unless there's more size there. Let's just assume there's only 100 shares showing. Everyone just showing 100 shares, with the exception, meaning that you put it there, you're saying that you will buy or sell 100 shares there, whatever you're putting. But now let's say somebody is like, oh, this thing is moving and I've got all these shares that I've been sitting on for a long time. Maybe they've got 300,000 shares and they were like, I just want to lighten up on this. So I'm going to offer out 5,000 shares above the best offer. So the best offer was 52. So they're going to go, you know what? If someone really wants to stretch and get themselves done, I'm going to put these shares at 52.10 or 52. Yeah, let's say 52.10. So a nickel above or 10 cents above the inside ask. So the inside ask is at 52. The inside bid is at 51.75. And stay with me. You'll be okay. So we've got a quarter spread. I'm bidding 100 shares at 51.75, offering 100 shares at 52, but there's 5,000 shares above the ask at 52.10. So I'm sitting there going, man, I know how this is going to work. I'm going to just keep on getting 100 shares here, 500 shares there, and this thing is going to keep ripping up way past the 52.10. So I'm deciding, you know what? I'm just going to stretch up and I'm going to go ahead and just take that 5,000 shares at 52.10. So I'm paying up 35 cents more than I would normally if I just sat and was patient and sitting there on the bid, right? With the inside bid was 51.75. So I'm going to go all the way up to 52.10 and buy those 5,000 shares and just grab those. Now that goes out on the time and sale. So now I'm done. I've got my 10,000 shares done, and the average cost is somewhere, in between there, closer to 52 because I stretched up to 52.10. Now everyone sees that someone paid above the ask and got these shares done, and and you would have gotten whatever was there at 52 as well, and 52.01 and 52, but you've gone up and you've grabbed those. You've grabbed everything up to the 52.10 to get done. So now you're done, right? You're sitting there, okay, your average cost, let's call it 51.90, and everyone else out there, they don't know if you're done or not. They don't know if you have more size or not. So then there's all this movement that is going on and people testing things out and moving things around. But that's the market, the very basic level of market mechanics. So let's kind of summarize what we've done so far, because this is going to get, not everything is going to get complicated, but I could see this being complicated if you've never traded this way. If you just gone into your, whatever you're using, your Robinhood app or your Interactive Broker or Fidelity or whoever, and you're just like, oh, buy me 100 shares. And you don't even think about it. You're just like, what's the price? Okay, buy me 100 shares. You're not thinking about the market mechanics behind it. And right now, this is all done by computers. Like the vast majority of it is done by computers. Even if a person is directing it, it's algo related, which is one of the issues that we will end up talking about. So during this normal transaction that you were going in there was a lot of other volume that wasn't truly buying demand out there. It was just market makers going, there's somebody in there who's trying to get a position of this. Let me jump in front of them. And they're just trying to make the difference in the spread. They're trying to buy it as that spread opened up from the original, what did I say, maybe 10 cents, 5 or 10 cents up to the quarter. They're trying to make the difference between their buying it on the bid, selling it on the offer, and then making as much of that quarter as they can. And that's how they do that all day long. And even if they get just a little bit, that adds up, and that's big money over a year. But so with this, people also don't want to get hosed. So you get a lot of this activity that's going on, and that translates into volume on the tape. Now, let's say there was a big expense to people on that and less volume in the market. So there was more of a chance that you are getting caught with that. So right now, the volume is very, very liquid compared to what it was historically, because there are lots of players in there. Your natural players and your passive players. Meaning passive, I would say, is anything related to ETFs, where it's not true buying demand for that one individual stock. It's buying demand for, let's say you're buying the Qs. Someone's in there buying the Qs. Well, the Qs are 100 different stocks, right? And maybe their real intention is they want to buy some more NVIDIA or Apple or Amazon or what have you. And that's what they really want to increase, but it's also going to come along with Google and all of the other ones down to your smallest of that of the Qs, whatever your smallest weighting is of the Qs. So that's more passive, and that's a whole topic for another one of these. Man, this is going to be hard to teach. Oh my God, what did I get myself into? This is going to be a mess. This is going to be a lot of them, but I got to do it, right? Because I've put myself out there saying volume is dirty. So I got to explain all this stuff. So let's do just a Cliff Notes version of what's going on. You've got the spread, the difference between what you pay for it or you can sell it for. And you have different size along there. So you've got your spread, you've got your different size, and then back in the day, you had commissions, which were significant. Then you got what I was just explaining, which was slippage, meaning you're going in there with any size in what you see on the tape, which was originally, I think we said the offer was 51.50. That now, but we paid 51.90 for these 10,000 shares, and be like, well, why didn't you get 51.50. Well, because there was only 100 shares offered there. And by the time we work this order now, we're up to 51.90. And during that, you had a lot of other volume that was going on that wasn't truly going along with your shares. Much more now than back in the day, because one of the things is these spreads are so small compared to what they used to be. I mean, you could have had a $1.50 spread back in the day. What I mean, easily $1.50. So you're paying 51.50 and then you're selling it for 50.00, 50 the figure. And that was being very, very normal. So if you're going to go in there now when when spreads are tight and commission is cheap and you got to just blow out those 10,000 shares, well, you can dump it into an algo and get out maybe 25 cents or 50 cents or something like that. So there was a cost involved. So size always increases that cost. But let's say you were back in the day and you were going to do this, well, man, your slippage could have been many, many percent. And if you're trying to trade tight with your stop loss, by the time you get executed, you're in a world of pain because maybe it costs you 3% to get in. And maybe you add the commissions on there, and now it's a cent. So you're buying it, and now you're 4%. You're down 4%. So some people who trade a lot of options, you're probably more used to that because you get the bigger spreads and everything in the option world. So just kind of think through to that. Like if you go in and you buy, I'm not talking options that are super liquid, but go look at some more illiquid ones. And that's kind of how it used to be with stocks. You go in and you want to buy it, and you buy it up essentially at whatever the current offer price is. You're silly. You want to put those limit orders in between, but that's a whole topic for another day. But or probably not, because we're not going to get into options. But that if you're trading options, you'll have a better understanding of how it used to be way, way, way back. So forget the mechanics of that, all the nitty gritty that I was going through. It's more you've got money to put to work. And the price is currently 51.50. And now you're deciding where are you going to really be able to get done there? And if you get done there and then you want to turn around and sell it, what are you going to get done on those shares? So that becomes a part of your risk that most people don't even think about right now. But because that is diminished dramatically, like I cannot even express how different it is now versus back when I started, let alone back in the 80s, that the difference there is so small that people do a lot of activity that they don't really want to do. Meaning, if you want to do something in a big way in the market, you're willing to take that slippage and total cost of 3 or 4%. At least back in the day, you would have been. Now, no, like you don't want to trade something. If you're going to buy it and then you turn around and sell it and you're down 3 or 4%, well, you do that enough times on without being right or wrong on the stock, but just the transaction aspect of it. And you've got to be doing really well just to be maintaining even. And this how it was even like in the 90s. Like I'm just telling you, it was really, really hard to make forward progress over this. So you had to be on your game because of the slippage and the commissions that were involved. I mean, I'll tell you, like my commissions told us on other episodes and on IBD Live, when it first started at the firm, Bill forced, there was no alternative, forced us to trade through his discount brokerage firm that was called the Stock Mart. And a lot of people who took the paper or took daily graphs would just trade through that. And it was kind of it was a novelty. It was trading through Bill's place. But for us, I don't know what it was for the outside folks, but for us, it was $28 a ticket plus a nickel a share, meaning you go in to do a transaction and that costs you $28 and then a nickel for every share. And then, so whatever that was, it was, and you had to trade through them. And that's part of your cost. The other part was the slippage, because back then you didn't trade in decimals, you would trade in fractions. So there would be 51, 51 and a quarter, 51 and a half, 51 and three quarters. So those were the quarters, but then they would also break it down into eighths, and or eighths and it, they would get smaller in some instruments, but for the most part, it was in eighth was kind of the smallest normal increment. There were smaller, but so you would break that up, and lots of times it would be like 51 by 51 and 5/8. So that spread, or that 60, what was 62 cents or whatever, would be what would be normal. Like it was just normal. So that costs on top of it. So you're $28 a ticket or more, depending on where you were trading. That was a discount brokerage, right? Full service brokerage was maybe $200-300 or more, for one trade. And then the nickel is share. So if you're trading a lot of shares, that would add up. And for the first few years, I was trading there, because until we were allowed to trade away, meaning trade through other places, we went to TD Ameritrade, and I think I had some E-Trade in there, which was like 7.90. I was so happy to only pay 7.95 a trade. Um, and anyways, I was paying Bill through his stock mart my salary, and sometimes more, in a year, just to trade through it. And so you had to, and I've talked about this in my 1999 um, case that got me noticed by him. I was up 1,640%, but that without options. Uh, and that was with this. So imagine you had the exact same trades, but with no commission, what that would have been. So it's totally different now. So if you're looking at the market now, you're learning. If you're learning now, you're learning at the best time ever. You've got all this transparency, meaning real-time news that's free. Back in the day, like if you're going to get news, you're going to get it delayed by a day. Maybe you read it in the newspaper the next day, or you had a wire service or something that you had access to. But it was just getting news or even real-time quotes. That was it was really hard. Things are, times have changed, and you've got to remember, like when times change, there's these things that end up changing along with it, that sometimes are positive, sometimes are negative. You always want to look out for negative unintended consequences. A great example of that, and this isn't a tangent, this isn't off topic, it's just something that we were going to talk about in a future episode. We might talk about it later today, but the regulation FD, or regulation, what was it, fair disclosure or fair, whatever, FD, whenever that came about, that changed everything, and it changed the volume in a very material way. And there were more negative unintended consequences to that regulation out of DC than anything else I can think of. So what was that, and how did it impact? And you can Google the years and the details on that. That what happened is, way back when, there was all this inside information that people would trade off of. I've never in my life traded off the inside information. I never saw Bill or really anybody. I know stories of people that I'm aware of that traded off the inside information, but never anyone in my circle of friends or anyone, because that's just a big no-no. Like, why would you do that? Like, risk going to jail and stuff for freaking money? Like, what are you, like, smoking? Like, what am I, Martha or something? No, I don't even remember what happened with her, but I think she's cool. But I don't remember. Maybe she did something really uncool, but I know she was in jail for something. I think Nancy went to go visit her there. All right, so I'm gonna get myself in trouble. Okay, so where was I going with that? Reg FD. So what had happened is, back in the day, there was all this information leakage. That would be the nicest way to call inside information. And these big companies would talk to the investor relations or the CFOs of these big companies would end up talking to their uh, whoever the person was at a big fund family. I'm not don't want to name any fund families that names, but they all did it. Hedge funds, mutual funds that they would talk to them before the earnings and be like, "Oh, this is how the quarter is going, and we think we're going to hit it, or we're going to miss the numbers." Wink and a nod type of thing. And so if you study things historically, you didn't see gaps. There weren't gaps during earnings. Very rarely was there a gap because everyone already knew it was built into the price. And that was kind of the basis of technical analysis. It was into the price. And Bill would always say that if there was a gap down, he'd say, well, it's in the chart because all the information was there because all the players that really counted from a dollar standpoint knew that information, right? So they had that. Let's say you're at a big mutual fund company and you're in Cisco back in the day, and you're like, oh man, you're up to your eyeballs in the stock, and it's chart is acting a little funny, and so you call up the CFO over there at, well, I don't even want to say Cisco because then that implies they did something wrong, but XYZ. Well, I can't even do XYZ Corp now. Whatever, 123 Corp. Lotus 123 Corp. So this random company you're in, you've got size, it's coming into earnings, and you're a little nervous because some of the competitors aren't doing well. And so you call up the company and get a feel for things, and then you walk away with, yeah, you should reduce it because whatever, something the environment is soft for their product. So then you're reducing that and it shows up in the chart. So then when the earnings come out, there's not this big surprise because everyone who had any size to sell, they had already reduced it ahead of time. And so that's where you would have a weak chart going into an earnings announcement. So there wouldn't be this big shock in price. Same thing on the way on the upside. If you called up and they're like, oh no, we're gaining share from those people. The reason why they're down is because we're eating their lunch and we're doing really well. So then they go in and buy that that stock and sell off more of the other ones if they have positions in it. And so those go down further and this one goes up. So then when the earnings finally come out, well, it doesn't really move much because that was already into the price. That's how the market really used to work. Really, it did. Go back and study things and study the gaps pre Reg FD versus post Reg FD. Night and freaking day, man. Like, it could not be more different collectively. Yes, don't send me in and find some gap in 1963 on some stock, some random news or something, but I'm talking in general. And the earnings would come out throughout the day. It wasn't all this pre-market or post-market, but throughout the day, the earnings would be released, and that changed. That was a change as well that impacted things and had these gaps. So the regulation FD, what happened is the government said, and the government almost always has good intentions, whether you're left or right. For the most part, they have good intentions, and no one's sitting there going, "I'm going to put this thing and I'm going to mess with everybody." No, they're like, everyone should have all the information at the same time because the little guy is not getting the same information as this big mutual fund outfit. Well, that's true, unless you know how to read charts, because then it was always in there. I never called a company and talked to back in the day, we had to call some companies. Bill had us do that, but never even received any inside information from a company. I had been told some stuff that was questionable by some people at times, and I did not trade that stock. And I told them, you need to go tell your source that information needs to go public now. And it was very clear because you don't want any part of inside information ever, and you just don't. And even if I knew someone who worked at a company, I wouldn't even trade that company because I just didn't want any. Let's say I got really lucky and had a big position in it, and the next day it got bought out or something. I didn't want someone looking at me going, "Oh, well, he knew because his best friend works at fill in the blank company." I guess so. And Bill was the same way. He just kept things super clean, and so it was great having that environment. But the reality is, that's not how the market worked. The market, everyone knew what was in there. because they were getting the information except for the little guy or girl. And they would end up getting hurt because they wouldn't have this information. So the government was like, all the information has to be released at the same time. Well, that sounds really good. But now you have this jolt that happens 4 times a year to a stock where you get the most volatility and the most volume on this one day each quarter when those earnings are released, because now everyone is getting that information at the exact same time. Immediately, it's that stock is getting pushed up to a certain level or brought down to a certain level based on the new information that everyone is getting. So now there's all this additional risk 4 times a year that hurts people, and certainly hurts the little guy more and girl more than the big outfit, because the big outfit, they're really diversified. And so with, one of their bigger positions gaps down or something, yeah, that's not going to feel too good, but they're going to be fine because they've got hundreds or even thousands of other stocks. Well, the average person is going to have a much more concentrated portfolio, and that could have a really big impact on you. A 20% gap down or more on a stock, if you're concentrated, that really, really hurts. And that's kind of normal these days in this post Reg FD world. So with that, you you have all this volume and volatility that happens these 4 times a year. That ends up becoming a big part of this dirty volume. That's a huge, huge, huge part, because that involves the option market and other things. But we will end up talking about all these during this series. I don't think anyone's going to watch this because it's probably confusing. That's why I've held off on doing this for a year, because it is confusing. So let's kind of summarize where we are right now to kind of make sure that we're on the same page. What we're trying to explain right now is how volume is confirmation of the price. So the price goes up, you should have the volume that confirms it. Price goes down, you should have that volume that confirms it, that it's bad action. If you go up on light volume, in theory, there's not demand there. So watch out, it's not good. Well, that's true. 20, 30, 40, 50 years ago. Very true. Stock is coming down, but it's on light volume. Oh, there's no one really selling. It's okay. Just let it go down. It's on light volume. Again, back in the day, yes. Now, not the case. Not necessarily the case, because you don't know how much of the volume is being done somewhere else, or was already done. There's so many other things that we're going to get into, but the Reg FD ends up, that's probably a good one for us to explain today, because we're in almost an hour and really haven't gotten anywhere. And this is going to be a lot of these because this is a big topic. But people have asked for it. I've explained it's going to be tricky. So I don't want to hear one negative review. If I hear a negative review until this whole series is done, man, I just wish you someone giving you a negative review at something in your life when you're not done, because that wouldn't be cool. Now, if you don't want to watch or you have something negative to say, keep it to yourself. Remember what your mother said. So uh, let's just tackle the earnings, since we were on the Reg FD. So now versus back in the day. Back in the day, as the quarter is winding down and the CFO has a handle on where things are, they're trying to give info out to their big, we'll just call them clients. Well, not really clients, but owners or potential owners. So the mutual funds and hedge funds. So they're giving out that information out. They're going to give out the bad information as well, because they want to have credibility. So the company or the portfolio managers will trust them in the future, because they're playing the long game. They're not worried about this one quarter. They're worried about the next 5, 10, 15, 20 years of this relationship with these outfits. So they're going to give them real information. And if not, that's where you would have gotten a gap down back in the day. And then the same thing for positive information. And they're getting that information out there. And so that's what the chart bases were formed by the old saying, and someone at the firm used to say it, and I think a client had said, hey, they were not a technical analyst. They were big fund manager with a big ego is how I interpret this. And you'll get that in a second. And one of our sales folks or one of our folks were trying to talk to them about chart patterns. And hey, you should look at the cup with handle, blah, blah, blah. And it means this. And he goes, charts, those are my footprints. And when I first heard that, I thought, wow, what an ego that guy has. And then I thought about it. Yeah, he's exactly right. Those are his footprints because a big mutual fund outfit, they're not in and out. They're not swing trading. They're not position trading. They're holding things. They've got low turnover. Look at the turnover in most mutual funds, very, very low, very little activity. It's all done on the margin just by dialing things up and dialing things back a little bit. And we talked about it in the last episode of the closet indexing and all of that and all goes together. So with this, they are making their tracks, and that's what you're seeing, and that's what a chart pattern is: a big cup, a big double bottom, a big saucer, a big whatever, beautiful high tide flag. That is the footprint of big portfolio managers who can't hide their buying or their selling because they're doing it over months or even quarters of getting in and out of these stocks. And that marginal buying or selling pressure moves that stock. And typically they have, because I remember, when we were dealing, because I dealt with institutional clients for, you know, 20 years, that they were uh, luckily I didn't have to talk to a lot of them on a regular basis, but when I did, I would always, ask what I thought were good questions of trying to understand what it was like to be on that side of things from a mutual fund standpoint. And lots of them would say, okay, I'm not going to buy or sell more than X percent of the average volume in any given day. And I think Warren Buffett even said that too with Berkshire, that I don't think they would do more than either 5 or 10% of the volume on any given day. So that means getting in or getting out would take them weeks or months, or quarters to do that because you don't want to have this big volume showing up because it would that whole thing that we were talking about at the beginning that I know that we took a lot of time on that bid ask thing that probably confused a lot of people, that you do that every day and you're trying to build a big position, you're trying to buy hundreds of thousands of shares, that's going to move things, is going to move things around. And then people are going to see the net buying or the net selling from people. And that's what creates the patterns. So that's the way it was historically. So you'd see this beautiful action and the cup would look a certain way and then they'd break out and then the news would happen 2 or 3 weeks later after the fact, or the stock would start breaking down and the chart would look terrible and you'd be looking for news and there'd be no news around. But 3 months later, you'd find out why everyone was selling it. That happened with Enron. I brought up Enron earlier. We had that on the NESME list near the end, uh, before it rolled over, because the fundamentals looked great because they were all made up. If you don't know what Enron is, there's nothing wrong with that. Just Google it and see. Anyone who's been around the block for a while remembers it. But if you're newer, you don't know, but it was a big fraud. And we had it on the list. Everything looked good, but the chart started looking funny. And so we removed it. I don't remember if it was Bill's idea to remove it or mine or how it came off. It was just a nothing thought. It was like, oh, stock isn't acting right, just remove it. It wasn't like, oh, we think there's fraud. And then later on you ended up finding out all the problems. And that's because of people who knew, really understood what was going on, and they were selling it. They weren't saying, "Oh, there's this fraud here. Everyone get out before we do." They were looking out for themselves, and they were getting out, which I don't know how ethical or legal that is, but that's just what they were doing. But we were just interpreting the chart, not any inside information. We were just looking at the chart and say, "Okay, it's rolling." Removed it. Didn't think twice about it, and then when it fell apart, it was like, "Oh yeah, we used to have that on the list." And then we look at it, and then Bill would always talk about it with people because it's pretty cool. But it's just a cool example of how charts help you. And looking at the fundamentals. Fundamentals are something to a reason to buy, but not necessarily a reason to sell. If you wait for the fundamentals to tell you to sell, you're going to be selling way, way, way late. But okay, so now we know how it used to be. It was all in the price. And then, well, why would a stock go up or down? Well, the stock would go up or down because of the general trend of the earnings and sales and return on equity and margins and all the other stuff in there, what the group is doing. But you wouldn't have these big 4 times a year. It would be kind of a pseudo non-event that is you're going into earnings. You're like hoping for some little bit of a surprise or a little bit more color on something, but not like it is now where it's like it's like if you've ever gone to Vegas and you've rolled the dice, that's what it is going into every earnings. You have no edge, none whatsoever. You think you have an edge, you're full of it. Go test that edge in a big sample size. You have no edge. Well, no edge that I'm aware of. There might be an edge out there, so I wanna back away from that statement. There might be an edge out there, and it's on my to-do list to try to figure out, and I'll just tell you now what I'm gonna do is just do it old school, and just like what Bill said in the book, The Fish Story. If you don't know The Fish Story, it's a basis for all of the way I approach research, and it's in Bill's book, How to Make Money in Stocks, and just a paragraph or so. And I've told it on other episodes, but it's important. It wasn't one of Bill's stories, a story that Bill told, but it's an old story. And I'm just going to summarize it. That there is a Harvard professor. He tells his students, "Hey, write me a story about fish." So they all go to the library and everything. They write these beautiful books, not books, but multiple pages on I'm embellishing, but it's fun. All this great stuff on fish. Maybe today they would use AI and have Grok or Chat GPT or whatever write this plagiarized story for them. And they turned it into the professor. And what did he do? Well, if you know the story, you know what he did. He threw that in the trash. He said, this is so important. If you want to know about fish, just sit in front of a fish tank and look at fish, right? Oh my God, that's so powerful. Think about it. If you want to know about fish, just sit in front of a fish tank and study fish. And so that's what these kids did. And then they wrote these stories on their original observations. And that's what I do. And I saw Bill do that. And if you think back to him with his PE work, we'll have to circle back to that in a second, but that's where that whole thing came from looking at the fish tank. And that's what I've done. I mean, I've sat and studied charts for my adult life. Like I've said, other episodes, like 5,000 charts a day minimum, like on a slow day. That's what I do. And I've always done that. I mean, to the point where early on, maybe 25 years ago, we used to have people who were trying to steal data from us. So they would kind of scrape our database on the institutional side, and they would go in and just pull chart after chart after chart, and then read all that information and put it in their database, and then cancel their accounts with us, and then they would have all of our data. And the data was extremely valuable back then because it was very clean. I mean, I was in the research department putting that clean data, and there was 30, 40 of us that Bill employed to scrub this data and keep clean data. That's why I'm kind of a clean data freak. We weren't just buying the data from some provider. We were doing it ourselves. I was getting the press releases from the wire monitor. There was a wire room, and they would have this paper that was just constantly going, and they would just rip it off, and then they would bring it over to your desk, and that would be the earnings for Apple. And then you would have to read it, go through it, back out any charges, look through all the footnotes and all that stuff, and put that data in the database. And that was very expensive and very time consuming. And Bill was paying for that. And so it wasn't cool that people were just stealing from us. I mean, it was kind of like the Napster thing back in the day, but magnified. What they would do to see if anyone was stealing data from us is they would just have a counter on how many charts I pulled up. And if anyone pulled up more charts than me, then it was a computer doing it because no one could it's just what I've always done. And so that was me looking at the fish tank. And if you didn't watch the last episode, episode 56, my Sundays, any given Sunday with Bill, I would highly recommend watching that. Really, I was worried about it when I was recording it, like I'm worried about this one. But in the end, I think it was really good. And I would go back and watch it. So we were um, going through the two different examples, right? I'm sorry, my mind is on a million things, and I've got a million work things on top of that that I'm working on. I'm redesigning Pattern Rack, the Growth 250, all the ratings at work, and plus normal work, and I am maxed out, like maxed out. My brain hasn't been at full capacity like this in a long, long time. Over a decade, and so sorry if I'm a little bit all over the place, but I'm trying to help out. I really am. So we were talking about historically, right? Oh, going into earnings, right? Is that what we were talking about? No? Dude, speak up. I'm asking you a question. That's very rude of you to not answer. I'm having fun. Just trying to keep you awake. All right. So where I think we were is going into an earnings announcement now. So back in the day, it was all the information was out there, was already in the price, and the footprint of the institutional clients or anyone with solid money, they're moving the chart around, right? Now we're in this post Reg FD world where an earnings comes out and four times a year, obviously, right? Or, well, not in all cases. You get some foreign stocks that only report twice a year, but we're just talking about normal US based stocks. Four times a year, you get this information that comes out, and nobody knows the information. And so now you're going in there and everyone instantaneously gets this information at the same time. So all the PMs are like, okay, I was estimating that the sales were going to be 20% up, but they came in at 25%. Okay, so they put that number in there, or it's put in there automatically for them. Then margins, oh, we thought they were going to be 13%, but they're only 10%. Okay, and the earnings were this, and they've got all the information in there, and in their spreadsheet, they look at the value and they go, okay, well, going into the earnings, the stock was trading at 51.50, but now with this information, and we thought it was worth $60. But now with this information, our projection is that it's worth $75. So that they immediately go in there and they're going to buy as many shares up to $70 because they don't want to pay 75 if they think it's worth it. So then there's automatically jumps up to 70, right? It just instantaneously. And just think about it next time you look at earnings, just go how quickly that stock moves up to this level and just kind of stays there. In most cases, not all cases, right? Because the information changes as people listen to the conference call and there's your question and answer and you're getting more color on there. But your initial move typically it's almost instantaneous because people big gap up or big gap down, at after hours or pre-market because everyone has put this information in the spreadsheet and the powers that be, the people that have the deep pockets, they now are willing to either pay up or they want to get out. And so all this activity happens at the same time. That's just a lot of volume happening. How is that clean volume? How is that clean volume? Explain it to me. It is a reaction to this four times a year adjustment. It's all coming at the same time. It's artificial because, and this isn't why volume is dirty. This is one of the many, many, many reasons, but I'm just going to go through this example. So four times a year, you get this reassessment of value because of the information that came out from the company. And people have figured out, okay, now instead of 51.50, they want to pay up to $70 for the stock, or they want to sell it all the way down to 40, but they don't want to sell lower than 40 because then they think they're getting bad prices. So they immediately just hit all the bids down to 40, and then they offer it out at 40 and $40. And so if anyone wants to buy it to them for 40, they're doing it there. Or same thing in reverse. They buy all the shares up to 70, and then they sit on the bid at 70, and anyone who wants to sell shares to them, they get sold to them. So that's the reality of what happens. Is watch any earnings announcement that happens. Now, along the way, sometimes that'll go along with something on a chart pattern that is going through a trend line on the way up or the way down. And so then there'll be technical buying or selling, or it's going through a stop level, buy stop or sell stop level that is, well, you wouldn't have buy or sell stops in the after hours of pre-market, but the mental one of like, okay, if the stock ever gets through $60, I'm buying it, or if it ever falls through $45, I'm selling it no matter what. There are these levels that are risk management levels, but what I'm talking about is what did the fundamentals do? So 4 times a year, you get this movement. So all the bulk of the move is happening kind of instantaneously 4 times a year. So that is created so much more risk in the market, especially for the little guy or girl. Even though DC, and I don't even know if it was Dems that wanted it or Republicans that wanted it, it doesn't matter. The thought process behind it was logical, but they didn't think about the unintended consequences, and DC never does. They just do what sounds good for the most part. I don't want to be negative on them, but yeah, and it's DC after all. Both sides, not all of them, but most of them. And it's a topic that we're not going to talk about. We're not going to talk politics here, but as it impacts the market, we will. So they have this good intention. So now you have this thing that 4 times a year, you get this big movement. Okay. So is that volume really real? Well, it's real because it's traded through there, but then you've got a lot of people who are in there who are where the movement happens. And so you've got high frequency trading, you've got algos who they're not caught off guard that there's going to be this big movement. So they're in there trying to front run not front run in an illegal way, but get in front of all these buys or sells as the big funds are in there going in there trying to buy it. So you've got all of that activity. And why are they doing that? Because they can, right? Because the commissions are not, are the after hours and the pre-market's a little bit trickier because of the way the orders work then are kind of more like back in the day where you've got the relatively big spreads compared to the normal trading hours and everything. But so you've got all of that volume that is going on, and you've got all those people that are trying to jump in front of it. And then because commissions are free during the normal trading hours, when the on an earnings day, you typically get tight spreads, not in post or pre-market, but during the trading day, because you've got all of this volume, and with the volume, you get more market makers and pseudo market makers who want to go in between the spread. So the more people going in between the spread, the closer that spread is. So when we were talking before of like a quarter spread, like 51 and a quarter bid by 51.50 ask, that now that might be 51.49 by 51.50, or it might be 51.49.1 by a little bit less than 51.50. So 51 49.9. So people are jumping in fractions of a penny, and that's a whole different topic. So people just trying to be the inside bid, inside ask, and they're just trying to make the difference there. So you've got all this volume there that is people just jumping in, trying to make the difference. Is that buying demand? No, it's not buying demand. So that volume, how do you back that volume out to get clean data? The person who really wanted to buy those 10,000 shares, how do you figure out if that person was going in there and then wanted to buy 10,000 shares, but ultimately because of all this market activity, it translated to, by the time that person was done, another 50,000 shares were traded. Well, how much of that was someone else with another 10,000 shares, or how much of it was just the market mechanics around that that order of people just jumping in front of and trying to make these fractions of a penny sometimes in spread because they can, because it's cheap. Back in the day, you couldn't do that because one, it wasn't by decimals. You didn't have the pre-market and the post-market the way we do now. You didn't have the individual options like we do now, which is something we're going to talk about in a second. So it was during market hours and it was real buying, real selling pressure, and you didn't get these gaps that were magnifying the problem. So now 4 times a year, the stock goes up a lot or goes down a lot, and then doodles around until the next earnings and then goes up or down a lot and so on. And the really nice traders don't trade big on those earnings so much, and it's more predictable, and those are just harder to find. So we should get into the option thing because the option thing is a big part of this thing. So now you had all these players out there going, okay, well, 4 times a year, you get these big moves that happen. How can I go in and reduce my risk in there? And we're getting to the tail end of today's volume 1 of this dirty volume thing. There's so many, dude, this would be like a week long. I know I'm probably sound like I'm all over the place because there's so many fringe topics I'm trying to like not get into because then they're their own tangents. But let's just deal with a little bit of the options up first. So now I've got a lot of friends that I've met who are really, really good with options. They've got deep knowledge on options. So they'll understand this to a level that I just don't because I've never spent the time to really get to that deep level. But let's just think about it this way. You've got 100,000 shares in Microsoft and they're going to be reporting and you're a fund and you're going, oh man, you think out of the last 8 quarters, it tended to move 10% up or down, or I mean, that's a whole separate topic that get really detailed. But so let's just broadly say, okay, well, it can go up or down 10%. And I just don't feel comfortable with that with the risk in my account. So I'm going to hedge a lot of this so that the worst case scenario, and then they plot out with different strikes and everything, they're going to buy in the option market in a way to protect themselves to a certain extent. Right? So they're paying something for that, right? Because of the whole volatility crush and all that stuff that we're not going to get into. And they're putting buying pressure on the option market because they're going into this risk event and they want to reduce their risk. Very smart. So they want to reduce their risk going into that. So they're in the option market. Or maybe they're like, I'm going to reduce my 100,000 shares down to 50,000 shares, but I still want that upside, but with limited downside. So they're going to go into the option market and kind of do an artificial 50,000 shares, like to get the deltas right, to get them to the right and factoring in what's going to happen to the volatility, implied volatility post earnings and all of that stuff, which all these moving parts, each of the things that I'm talking about have a lot of moving parts. And then you get the what's been really popular lately for folks to focus on. It really happened with like the GameStop and what was it, AMC, and there are probably some others of these meme stocks with people buying, options really far out of the market, and then the market makers happen to go into the market to offset the risk that they're taking. Well, we might as well get into that a little bit. So this is where it gets complicated. You've got 100,000 shares of Microsoft going into earnings. You want to reduce that down to 50,000 shares of just pure equity, and you're going to let that ride. But you still want your 50,000 share type of upside, but with less downside. So you go in and you figure out, and we're not going to get into that. You figure out the option contracts that you want, a combination of different ones that you want to get to a. Hold on a second. I'm getting sorry, I was having to deal with something. So circling back to this. So you've got your 50,000 shares that you're just sitting with, and then you've got another 50,000 shares kind of synthetic through the option, through various options that you're buying because you still want that upside, but uh, you want to maintain the risk on the downside, because even though you thought that historically it's moved around 10% on earnings, you don't know. This could be that one that moves down 20 or 25%. And so you want to reduce your risk and kind of have some of it at a known quantity. Now, maybe uh, you want to sell your whole 100,000 shares and just do everything as an options. Yeah, that maybe, or maybe you keep the whole 100,000 shares and then you buy. You still go into the option market to just hedge yourself. So all sorts of ways of of accomplishing this. So that's you. Now, there's someone on the other side of every trade. So you're in there and you're buying, let's say you're buying a bunch of puts on there, but you're really bullish. You're just buying those puts for protection. And so someone might look at all this put activity in Microsoft and think that it's negative, but really you're just mitigating the risk. But they're reading into that a certain way, and they're like, wow, look at all this unusual option activity. Well, it could just be really someone wants to dial back their risk and they really think it's going higher, but they're buying these puts to just protect their downside. Or maybe you could flip that around. They're buying some way out of the money calls because they think, oh, this might be the quarter where it gaps up 25% and they want a little extra juice if they're going to hold their 100 shares going into this. So they're out there either buying a bunch of puts or buying a bunch of calls, or maybe doing a little bit of both. Now, the person on the other end of that trade, of the option trade, well, they're the market maker typically, and unless you find someone who just wants a opposite side, but let's just say it's the market maker, and they've sold you this contract, this put or this call. They want to mitigate their risk. So then they go in and they buy an offsetting amount of shares or sell an offsetting amount of shares to neutralize that option risk that they are taking by selling you those contracts, the puts or calls. So really, you just had 100,000 shares. You're just sitting in Microsoft. And back in the day, you would have just sat through those 100,000 shares, or maybe you would have had 200,000 shares because you didn't have this risk 4 times a year and you would have felt more comfortable with a more concentrated account. I can tell you this now, like if Bill would have not retired when he did, eventually he would have come around to the Reg FD. Now, he did not agree with me on Reg FD at all, at all, at all. And he thought it was still in the price. And I'll tell you, man, I'll just tell you this. Well, shoot, I got to finish this first and then I'll tell that story. I am jotting that down. Remind me, Twitter, Facebook, story. So, uh, the 100,000 shares back in the day, they would just be holding those shares, or maybe 150 or 200,000 shares. And it would have been real because they wouldn't have been thinking 4 times a year, this event is going to happen where you're going to have this, um, all this volatility that happens. And sometimes it's a non-event and it just stays the same. But most of the time, you get movement. It is very, very abnormal to not have movement on an earnings day. Back in history, it was very normal to just have a little bit of movement or no movement. But now this big risk event, right? It's kind of like an election or something. This big thing is unknown. You're going into it, this big crapshoot. So back then, you would have had real shares traded, and I'm talking before there was even an option market for individual stocks. But now, because they can go in with the we're not even talking inverse ETFs and individual stock ETFs that are leveraged and inverse and all that stuff. We're just talking options right now. So now they've gone out into this option market and bought their protection or got their juice for some extra movement. And the market makers have had to go in there and hedge their accounts. So all that volume that happened going into this earnings, just so people could mitigate their risk because of the Reg FD, well, is that buying or selling pressure? Is that confirming activity or is it just nonsense? Complete and utter nonsense. It's shares that are showing up on the tape because someone is trying to reduce their risk. They don't have any buying or selling that they're really doing. They're just trying to mitigate the risk in a big way. I'm not talking about the mom or the pop, your Aunt Sally down the street, as Bill would always say, who's buying, one lot of something or, one option contract. I'm talking size that they're doing this in or collectively. So it doesn't have to be one guy or girl with 100,000 shares. It could be, you know, uh, 500 people with smaller, but collectively, this is all um, this is all happening for this risk event. Now the risk event happens. The earnings come out. The volatility of those options go because that risk event is now gone. So that's not in there. So that price goes down dramatically, very, very quickly. And so now those options are priced differently. So everyone, that's changing everything. And people are adjusting their positions. They're either their option contracts, reducing those, eliminating those. And then that comes with its own activity in the market as those market makers are adjusting to neutralize their risk with that. And all for what? Because Reg FD came in there and it ended up creating this risk environment that people needed to adjust their risk for. And you get all this volume that is just natural that is going to happen with all this stuff. And then you have people who were just waiting because they're like, you know what, I've got 100,000 shares here. As long as it doesn't gap down 10% or more, I'm just going to increase it. They want to increase it to 150,000 shares, but they don't want to do it before the earnings. They want to wait until that's behind them. And then that order's out there. So they've got that activity. We're not even talking about the natural buyers who weren't even in there now that good earnings came out and then they want those. We're not talking about those shares. Those are the real shares. That's a volume that you really want to track. We're just talking about this risk mitigating volume that's there. And what percent of the volume would you say is that? I don't know. I have no clue, nor do you. There's no way to calculate it with any level of true certainty that I'm aware of because you would have to know things that are unknowable of really what is the intent of that person who's buying those contracts. Are they trying to increase their risk? They're buying a bunch of out of the money calls and they're just taking a crapshoot on that, or they're buying a bunch of, puts that are out of the money, or they're selling a bunch, or they're selling a bunch of calls. You don't know what their true intent is. They don't say, "Hey, I'm bullish on this order." They're just putting that order out there. But back in the day, before all this pre-market, post-market, option market, not even talking about overseas and leverage ETFs, high frequency trading, no commissions, little slippage. They were just buying those shares back in the day. Now you've got all these moving parts in there and they're trying to reduce their risk. And so that you get all this volume that blasts in there on any given earnings day. And go try to find a stock that doesn't have a big volume on earnings days. And it cracks me up. Cracks me up. The veteran traders, some my friends who will go and stock is up 10% on earnings, of course is going to have a bunch of volume because of what we were talking about. And they're like, well, look at that volume confirmation. Well, find a frickin' earnings day that doesn't have a lot of volume. Like, yeah, you're going to find a couple here or there, but I'm talking like really on big, important companies over an amount of time. You're just not going to find it. It's just not there because there's all this volatility because of the market mechanics that happen around it. So how is that real? And the same thing would happen on the way down because now let's say the stock gaps down 20%. Well, you're going to get this pickup in volume, right? That happens because people are closing out the known risk event is now known, right? No, let me restate that. The unknown is now known. The date of the risk event was known. It wasn't like something that can happen with like a biotech that you don't know when the they might get FDA approval or some random news that just comes and just gaps it up or gaps it down or some other really random news event. This is a known thing every year. Okay, it's going to be released on this date for this quarter and the other date on the next quarter, and it's you can plan for it. So that's now gone, and they're unwinding those trades. The market makers are unwinding those trades, and so you get all this volume that is now in there. But on top of that, you get real trading. People are like, oh, wow, the stock is breaking down. I want to sell those shares. I didn't do any hedging, but now I want to get out of it. Or I wasn't even in the stock. Now it's up 10% on great numbers. Really like it. Or people that aren't wired the way we are, where something's gapped down 10% and they like it. Like there are people who love to buy in the dirt. And they're like, well, it's down 10%, but it's finding this level of support over here, and they're comfortable just buying it there and maybe letting it go against them for a week or two. And there's people that are very comfortable with that. I'm not, but I understand that there's those people in there. So you don't know what the real buying or selling pressure is in that volume. And so these people just boggles my freaking mind. These professionals, smart people who just or parroting what everyone has always said because they won't think outside the box. Just look at any chart and look at those earnings, the volume. Let me just share, I'll just share a couple charts. Let's do that because maybe this will be a little bit easier to get. Let's just look at really liquid, or let's just look at some liquid names here. And this is just a screen. There's a very generic screen of no closed-end funds or ETFs that trade a lot. And let's just look at the most liquid here. This is NVIDIA. All right, doesn't get more liquid than that. And let's put this volume over here. So look at that volume spike that you've got there. You got a volume spike there. You've got a volume spike there. Well, maybe you're not familiar with our charts. Let me turn off some of these corporate events. Okay. So this date here, that's when the earnings came out. That little EPS flag there, that's when the earnings came out. This little flag, that's when the earnings came out. That's where the earnings came out. Let's look at some other. Let's look at some that are liquid but not as liquid. Let's go down to like a. Let's go to Hood. Why not? Okay. So you've got. I'm trying to see which one will magnify it a little bit more. Okay, let's just do it here. So this, I think that was a day that was added to the S&P 500, if I'm not mistaken. But don't quote me on that. You could look at the earnings, but from memory it was. But look at all that buying demand. 202 million shares, 346% above volume. Do you see in there the little volume thing? So from the top, that little track price, you got the date, the price information, then the volume, and the volume percent. That the volume percent is how we like to look at volume versus average. So if it was the same as the 50-day average, which is this little red line down here, that's your 50-day average of shares, then it would show up as exactly there, and it would be a zero volume rate. Just like this day here, it's at a -1, so that's essentially as close to zero as possible because it's right at that line. And I'm just toggling back and forth between the arithmetic volume and the log volume because the scaling is kind of tricky to see. But let's just go back. We'll do it with the log. So on this day, yeah, pick up an earnings must have been post market, and all the volume was there. You had this dirty volume day because of S&P rebalancing. Then you had another one here. You had another one here. See that volume spike? You see how it's, and this is a big liquid name. It's spiking up there, spiking up there. Let's go to some more. Let's go to the growth 250 and look at some of the thinner stocks. That might be a little bit easier. Let's look at some like thin, but not so super thin. Okay, these are in like the $20 million volume. So you can see the volume spike there. That actually looks a little off, but you got a pickup in volume there. You had some funky volume going on there. Maybe it was, you have to 6.5 million shares, 4.2 million shares, but look, the price didn't do much. So it must have been something else, maybe added to an index or some other, an offering or what have you. Um, you have a volume spike here. Do you see how like the volume kind of subsides, goes up on that earnings day, comes back down to this general like U shape where here's your peak volume right there on that earnings announcement, peak volume at your earnings announcement, peak volume at your earnings announcement, pickup in volume over there, pickup in volume. So this day here, you've got all that volume and it's down 15% on the day, but that was a known risk event. So how much of that, it was 167% above average. How much of that was just unwinding of options? Let's go, let's find one that for the next time I do one of these, I'll try to find one that is a little bit of a better example. Um, let's look at this one. So you can see like all this normal volume, and you get a big volume spike here, big volume spike here, big volume spike here, big volume spike here. What do they have in common? A bunch of buying demand, a bunch of selling demand, or earnings. Freaking earnings. It's just earnings that is doing that. That's just one. That's not why I say volume is dirty, but that's one of them. What was this other one that maybe it would be easier to see on a weekly chart. We'll look at that in a second. But here, look at this at Mongo. Big volume spike here. This is more normal where this is a little bit easier to see. Big volume, no volume. Big volume, what's the difference? Earnings. Big volume here, big volume there. What's the difference? Earnings. It's not going on there. It's not going on there. Doesn't mean that the chart pattern didn't warrant a lot of buying or a lot of selling at the other places. It was this risk event, and you kind of see how it's a non-event. Like this is what I was talking about on this day here. Let's go there, 8/26, August 26. Okay, so this is what it looks like the day before that earnings. Now we go forward a day, and this is what I was saying with now all of a sudden you've got everyone's got that information in their spreadsheet and it gets pinned right up there. It was, yesterday it was trading 214. Now it's trading up to 297, 275 to 297, all because of this earnings release that end up coming out. And you can just look at these the volume spikes down here and tell where the earnings probably were. Let's go back to the current date and we'll see if that's indeed the case. Yep, big spike there, earnings, big spike there, earnings, big spike there, earnings, big spike there, earnings, big spike there, earnings. Now let's look at it on a weekly. And you can see them there too. These little flags there, same thing on the weekly where it's showing up when they came out. Look at all these spikes in here. Just look at the freaking fish tank. It's staring you in the face. It's saying this volume spike, volume spike, volume spike, volume spike is happening, and it's all around the earnings. So that's the most obvious thing that's very clear to see. And start doing that when you're going through charts. I'm going to stop sharing. Stop sharing. Go as you're going through your charts or whatever you hold. Just look at the volume and the times where there are volume spikes. Well, it's probably earnings. Then the other times would be there's a rebalance. S&P rebalances once a year, and I think that the Russell rebalances is it June or July, something like that. And then you've got the different rebalancing of different ones, sometimes more often than once a year, but you get stocks that are added to the S&P or removed to the S&P, and they have volume spikes on those. So those are the known things. Well, we've been going almost 2 hours, and we haven't even scratched the surface of the issues. So I'm just going to throw out just a couple different things to think about that we will be talking about in future episodes. Unless people watch this and they're like, I thought I wanted a volume episode, but I don't. And if you think that, just don't say it. But I'll know if I don't get, if there's hardly any positive comments, I'll know that maybe we won't do any more of these because, man, it's complicated. But so here are some of the things we'll talk about. High frequency trading, right? Just computers trading against computers. There's no buying or selling demand. There's just the computers trying to jump in front of other computers to try to just make that market or get that spread, get the fraction of a penny. It's not true buying or selling pressure. You get the passive flows that are happening from an ETF. Let's say, it's funny, this was a theory that I had for a long time and was talking to another professional last year about it, and he was asking me like, Mike, just tell me some of the stuff with the volume and why you think it's so dirty. And I said, well, one of the examples I gave him was, I said, okay, let's say you're at a shop and the maximum exposure you can have to any one instrument, any one stock is, say, 10%. And you've got a max 10% position in that stock, but you want more of it. Well, how can you do that but still get away with it? Well, what you would do is you would go in and you buy something else that has that. So let's say you want a bunch of NVIDIA or AMD or TSM or Broadcom, but you're maxed out, either of an official rule or just your own rule. You don't want to have more than 10% in one individual stock, which for a big outfit, unless it's a concentrated hedge fund, but for most big places, that's a big bet. I know we've talked about like having a lot more concentration than that, but I'm talking a big outfit. So what's another way that you can get that? Well, you can go in and you can just buy the SMH or another ETF that is a targeted ETF, maybe the SMH, and you can get some exposure through it. Well, let's just keep it simple with just the SMH. So you go and you say, okay, well, the stock that I own, that I have my max position in, is 10% of that ETF or 7% of that ETF. So I'm going to go in and I'm going to buy some of that ETF. So now my exposure to that stock is even higher than it was because I've got this portion of it. But you also have all these other stocks in that ETF. And this was just a theory I had. And I said, well, I've done it. I've done it not to get around rules, but get around my own individual risk rules that I'd have. Like, okay, I don't want to have more than X in any one stock, but I will have exposure to that group by doing some group ETFs, not to like get around some sort of restriction that is placed on me, but just my own thing. So I'm not doing anything shady, just trying to get some more exposure there. And he told me, he's like, yeah, I do that all the time. But he's at a shop where they do have rules on there. I was like, yeah, I thought everyone did that. This was just one sliver of things. That's people who do it consciously. There's also people who will do that subconsciously. They look at a sector, let's say chips are really hot, and they've got some NVIDIA, and they've got some ALAB, and they've got some, uh, whatever, all the different ones in the space, but they also want some juice by buying that ETF. Well, then they're in there buying that ETF. So where does that ultimate buying pressure? So you're in there really trying to increase your, let's say, NVIDIA position by having this SMH position, but you're also getting TSM and you're getting Broadcom and you're getting the thin little one too that's in there. So ultimately that volume then goes out to all of those other ones, right? Because the owner of the ETF that's a whole can of worms, but essentially there is a buying demand for more units of that ETF, or reducing the units. And that's a whole can of worms, and where I think the next flash crash is going to come from. But that's a topic for not this series. But so now there's all this random buying in all these other ones, and that volume is flowing through on the tape. Let's say you're targeting NVIDIA, but you're buying the SMH, but it's also going through to TSM, and people see the volume on the TSM and they're like, oh wow, there's all this buying in there. Well, no, I didn't even want the TSM. I just wanted NVIDIA, and maybe I was fine with AMD, but I didn't want the other ones, or vice versa. Just an example. I'm not an investment advisor. I don't play one on TV. This is not investment advice. This is just me just trying to help you out. So if you want investment advice, go to an investment advisor. If you want to just be put to sleep, listen to not put to sleep, but if you want to fall asleep, just listen to me. So with this, I hope this makes sense, but makes sense in my head, but I also know I'm all over the place. But that's what happens when you try to, take something that's so complex and not go off on tangents. But so now you're buying these shares in this ETF, and that's expressed out on that tape, or you're buying options on that SMH, right? Then you go out into the SMH, and then you're buying those, and then how does that volume then flow through to everything else? Or maybe you go to the Soxal, you go to 3x of that, and that's a whole nother can of worms. Or you go out and you buy the Soxal, you really want to magnify things, you go out and you buy some Soxal calls or puts, and then that gets floated through that whole thing that we were talking about before with the Microsoft example. So again, the things that we're going to talk about in the future: ETFs, high frequency trading, algos for individual trades, and true black box full algos. Algos, like I created Juan's first proof of concept algo that was rolled out over a decade ago there, but then it was sunsetted. And then I built a second one, and we never got a chance to get that one going, but it's been a couple of years working on all the full black box, meaning no human involvement at all once it was launched. So I had to think of every what if possible. And that's where a lot of this volumes thing actually came from, is my studies of that. So I will go into that in future ones, of how algos, full black box algos, impact volume, as well as individual algo for a trade. So before, when we were talking about that 10,000 share trade, well, now you could put that in with like an algo, like the ones that I have always used for a couple decades, or been a TWAP, or percent of volume, meaning a time weighted average price. So let's say you want to buy 10,000 shares, but you want to spread it out over a certain amount of time, or 100 shares you can do this with. And you spread it out over the entire day. So the computer just goes in there, and it will somewhat randomly over that set of time go in there and either do that buying or selling for you, to kind of try to hide it. Or one of my favorites, back when I was running money at O'Neill and at the shop out here, when I was a head PM at the family office out here in Austin, that I would do a percent of volume. So you don't want to push the stock up or down. So you just go in and say, okay, I want to be 5% of volume. So that algo goes in there. You just put the order in there, and you can put a limit order if you want, an ultimate top or an ultimate low in there, so it doesn't go beyond that. And it will just trade along at 5% of volume, or 1% of volume, or 15% of volume, whatever you put in there. And there's lots of other algos in there. So they are masking those orders, so you no longer see those big blocks that we used to see back in the day. And at the beginning, I kind of alluded to this thing that I created for Bill, that was a block trade indicator. So this is going back a couple decades ago, and it was only for the both of us to use, where we'd built it into Wanda, which was our institutional version. And it was this whole concept that I had, that if there were block trades in there, and it worked, if there were block trades in going on, you didn't really know if that was a buy or a sell, right? So blocks were typically thought of as like 10,000 shares or larger. And this is back in the day. And you'd see that show up on the tape and you didn't know where that really was. Was it a market maker finishing up an order and printing it on there? Or was it something that just hit just naturally? You didn't know what was going on. Were blocks just being crossed, one buyer, one seller type of thing, or multiple buyers and one seller. You didn't know what was going on. But what you did know, this was my concept, was what you did know is ultimately what ended up happening later on in the day. And if this is putting a complex thing into a complex indicator into kind of just trying to explain it easy, if you had a lot of blocks, a lot more than normal, so then you had to figure out what was normal, and that was a whole thing in itself. You have more than normal blocks and more than normal activity, meaning that the price was moving. This was before I was using ATRs, but ATRs would have helped a lot, but more than normal price activity. And then where did it close within the range? So the thought process is if it closed near the highs, that was buying, closed near the lows, it was selling. Abnormally large price move up or down, it was buying or selling, and lots of other things. But ultimately, what it would do is if it would interpret the blocks, and on balance was that buying pressure or selling pressure. And it was something we used for a while, and then ultimately it stopped working because when the algos started coming in, the blocks you wouldn't have the number of blocks that you would have back in the day. Because so now when someone puts a 10,000 shares or maybe 100,000 share algo in, that's getting broken up into 100,000 share chunks and sometimes less than 100 shares for a 100,000 share order. And it's getting, if you looked at your actual transactions of your fills, like, because that's what I would do when if there would be a size order that I would put in, I would, just out of curiosity, I would go and look and see where did I actually get filled, and it'd be like 55 shares at this price, 179 shares at this price, and so on, which was not what it was like back in yesteryear. But anyway, so we'll talk about, where was it going with that? So you talk about algos, which is a big topic. Where the algos have to think of everything, right, ahead of time, that, and it's all just computers talking to computers. So you didn't have the true buying, what do you call it? Like the animal spirits. It's just computers. They don't have animal spirits. They're just going off of what the code says. So you've got the option market, which is a big deal. You've got pre-market, post-market, which really changes things. Now you got the silly like 24-hour thing that they're trying to do. But you have individual stock ETFs that are like 1.5 or 2x the stocks, so leveraged or inverse leveraged stocks. So what about that volume? Then you've got ones that are let's say commodities. Let's say, like silver was, having this big move, and people are like reading into that volume, and I'm just like laughing like there's no tomorrow. I was like, are you freaking kidding me? Like, grow a brain, grow. I'm sorry, I don't mean to be mean, but like, think through it. Why are you using volume on something that then is also, a futures market, and then you've got options market, and you've got other ways of trading that same instrument, and you've got that traded in other places around the world. So unless you're going to do a consolidated tape of volume, and you're going to combine the option market volume, you're going to combine that ETF, the other similar ETFs that trade less than it, any leverage versions of it, and the futures market, and you're going to roll that up into one number. Well, how in the world are you going to do that? Because you don't know if the someone buying those contracts, because then you got both sides of it, right? A buyer and a seller, plus the market maker who's hedging themselves. So all this volume just turns it into being dirty. And like, how are you going to roll that up into one? Like, come on, man. Like, what are you thinking? And I'm not being mean, but it's, or while we're on that topic, it drives me crazy. people that are more veteran than I am. Been doing this since, been in the industry since 93, when I started working at T. Rowe Price in 1993. So I've got people that I know that have been trading, from longer than that, who will look at things like the Qs and interpret the volume on there. No matter how many times I say not to, they still like, oh, look at all that buying. Well, oh my God, okay. So you've got Qs, you got QID, you got QLD, you got TQQ, you got SQQ, you got the NASDAQ futures, you've got a million other things that are so similar to that probably have like a 99 correlation to it. Like you have so many ways of expressing that same thing. So you got the big NASDAQ futures contracts, and then all the way through to the minis and the micros and whatever else that they've got going on these days. And you've got the options on those as well. And you've got the options on all of those. So if someone was trying to hide their volume activity on the Qs, there's a million ways that they could do it. And why are you, dude? Look at a freaking chart is what I say. Like these people who just don't want to hear it and want to argue with me and have debates with me about, and it's like, dude, I don't have 10 hours to talk to you about this. I'm not talking about you guys who are watching. I'm talking about the people that, have been trading longer than me. They're thought of as these geniuses and stuff who just can't figure out to not look at SPY volume and Q's volume and IWM volume and whatever else and interpret it. Dude, just don't, man. Just think take a half an hour and think, and then just go, no, that just does not make any sense. You're not thinking. And I don't know how else to say it. It's like you really, and I'm not being mean. I'm just, there, anyone who's been trading for less than 10, 15 years, you get a total pass, like 100% total pass. Like, how would you know? Like, unless you grew up on level 2 or think of it, Bill was man, do I have those? Trying to think if I still have those pictures handy. I don't think I think I put them in storage, but I used to have these pictures of Bill back, they're black and white of Bill. And I think I've posted them on Twitter before well, let me go see if I can find it. Just hold on. Don't go away. All right. Well, I'm back. I couldn't find the pictures because I did just literally just put those boxes in storage this weekend, but I did find this one binder that I had with a bunch of stuff, Bill stuff. So that was Bill back in the day. Um, and put it in again to see if you can get it better. But those are essentially behind him. Those were his tickers, but then he also had around the top, he had this ticker tape that he had that kind of like what if you look at like Fox Business or CNBC or something, you got the ticker tape along the bottom that has the symbol and then the change. But what he would pay attention to were the number of shares traded, and then if there was a block on there. And so he was a tape reader, and he would always look at that, and we would talk about that. But I would look at it in time and sales on my computer. But that's how he had always looked at it. He was a tape reader, and if you go back to Livermore, he was reading the tape off the ticker tape. Like you just Google what a ticker tape looks like. It was this little, it was before my time, but it was this like kind of this glass thing with this continuous paper that would come out like this, kind of just like what you see along the bottom of CNBC and Fox Business. And it would, have the symbol and the shares and the price that it traded at, and information like that. And so you would back then you would read it as it was going, or Bill would, so that was how it was originally, and then it changed to a tape that if you could afford it, was going around the building or around your office building, and then ultimately with like time and sales and level 2 and all of that stuff. So the volume that he would have watched back in the day, that was real true volume that was going through, because there was no option market. There was no ETFs that people could get exposure to that way, or that was impacting that. There wasn't after hours trading or pre-market trading. There wasn't shares that were being traded overseas. Like, because if you don't know, there's also domestic stocks, meaning US stocks that are traded over in Germany and over in other places. So when our market is closed, those are open and that you can trade them there. And now this whole 24-hour nonsense and everything. So there's all the reason why I mention this is all these ways of expressing your bullish or bearishness on an area or an individual stock that didn't happen back in the day. So man, there's so many moving parts and a million other things that I'm just not getting into right now because then each one of these you can see it just goes off and on all these tangents of why this is so confusing. So let's try to summarize what we did today in this train wreck that I just kept that train a rolling, right? You know, one of their best songs, by the way, if you know what I'm talking about, or one of the songs done by many and over the decades. But anyway, we were talking about volume, and my concept of volume is dirty. Volume is extremely important. The concept of volume is extremely important because it confirms the price movement that you're seeing. That if that stock goes from $50 to $55, that was true buying pressure, and the volume coming in there was telling you that there was true conviction because the whole point of it was to not get false moves. Like I'm buried the lead, I guess. The whole point of looking at volume was to confirm, like, was there real buying pressure, or let's say a stock was coming off and it was breaking a key level, or let's say a 50-day moving average, but it was doing it on light volume relative to recent volume, whether the prior day or 50-day average, or lots of ways of looking at it. And you know, it was coming off on light volume, so there wasn't really a lot of selling pressure there, so it's okay. Well, no, now that selling could get hidden. Man, we're gonna have to go into some of these now. So yeah, yeah, I do. So one of the things that kind of got me thinking about this, one of the earliest things that got me thinking about it before I had any evidence on the tape or true evidence was Bill made this comment to me, and we were watching this stock. We both wanted to buy it, and we were looking at it and deciding what to do with it, whether to put it on the Nesme list or not, and then ultimately then we would have bought it. But it was breaking out. I just can't remember what stock it was, but it was at least 20 years ago. And it was breaking out of something, but the volume rate, which we watched like a hawk, because Bill would always say a volume rate you want on a breakout 50% or higher. And this was a liquid name, not some thin little one. And the volume rate was just stopping at like around 40 to 45% volume rate. And that volume rate would change throughout the day because it's prorated throughout the day and all. And I'll have to get into that topic another time. I don't want to derail this and have it be 5 hours today. So he was watching that, and we're on the phone, and he's like, Mark, you see what they're doing? You know, I'm like, what? And he's like, they're playing possum with this. They know they're not going to put this over 50% because they figured it out. They know that we'll all be looking for that. They're going to keep it there for it. And sure enough, they did. Now, I don't know if they cared at all what we thought, but if you think about it, if you're trying to build, and then he went on and we have this, well, I'll explain it the way he would have explained it because I totally agree with it. So the way he would explain it would be, um, if you're a big mutual fund or a big hedge fund and you're in there and you've got 500,000 shares of this stock and you want to end up having 2 million shares on it, and it's breaking out, and it's breaking out at $100, and you're in there increasing your position, and let's say you're trying to buy as much of it as you can, but you don't want the volume rate on the day. Again, remember the volume rate is how to measure anything above normal. So if it normally trades a million shares on the day and it trades a million shares that day, the volume rate would be 0. If it traded 2 million shares, it would be 100. If it traded 3 million shares, it would be a 200 volume rate. And what we found from a lot of our studies is a volume rate of 200% or more on a breakout was very significant. And I confirmed that with my big study that I did from 1963 to 2013 on every stock ever that broke out of a base, um, every base, and confirmed that that was very, very meaningful during that time frame. But that was clean data times. That, but we would preach, and he would. This was his thing, and I agreed with it. Was 50% was kind of that threshold that you want, and so this stock was at 40 to 45 that day, and it really got me thinking. And because he was saying, didn't believe him at first, but he's like, these people know and they still have a bunch of shares to be bought. And so they don't want to run this volume rate up too high because then you're going to get a bunch of us in there that are following this system. And so it's not anything pro or against any particular system. If you're the guy on the desk who's in charge of working an order for this big PM and you're tasked with the order, you're going to be watching that and not push it up, or just like, because they're getting, this is so complicated because there's so many moving parts. So you've got your head PM who's deciding, okay, he's talking to analysts, talking to the company and that they're buying. And they're like, okay, I want to increase this up to a 5% weight of my fund. And right now I'm at 1%. So that means we got 4% to buy, and we've got to buy that over the next, I want it done over the next 2 months. So buy as much as you can, but don't buy more than 5% of the volume on any given day unless this, or that. And then you're going to be, and then he gives that order to his desk at his fund family. And then that guy or girl takes half that order and then he puts the rest of that order out with his people. Like, because we had a big trading desk, right? Folks with Fidelities of the world and stuff would trade through. So then it gives, maybe they're going to be working 500,000 shares and they give us 100,000 shares, or maybe they're 5 million, whatever, like large amounts. And so, and he gives instructions that you're only going to be considered a good trader if you can get this done without impacting the price by X amount. And so they would look at things like what was the average weighted volume on the day, and were you above that or below that? And that's a sign of a good trader versus a bad trader. By trader, I don't mean someone who's deciding what to buy or sell. They are taking that order and they're working that order on the system the best that they can, sitting on a bid, taking offers, doing all sorts of things. Maybe putting, let's just think pre-algo time where they couldn't put it in with an algo. So you got a couple desks working this, and one of the things is they're saying, okay, well, don't put it through this level because the Fibonacci kids like that level, or don't put it through this level because the Bollinger folks are going to then be all over it, and don't put it through this level because the IBDers are going to then buy it. And so they're aware because that's their job, and they're doing a really good job at it. That's their task. Their task isn't to figure out, is the general market good? Is the general market bad? What sectors are good? Sectors are bad. What stocks to buy? What stocks to sell? What stocks to hedge? They're just order takers, and they're really good at it. And they're trying to do a good job at hiding things. They don't want to, like, it's like, it's a big poker game. They don't want to go, oh, I've got aces, hey, or I've got a 7-2 offsuit. They're trying to act like they've got something they don't. It's a big poker game. So that's what Bill was essentially saying. And he would always say, call me up, and it would be like a really good stock and there would be no volume. Like the volume rate would be negative, meaning less than average. And granted, we did this like prorated throughout the day. So the volume at half an hour into the market was different than what it would be at, half an hour left in the market. And that's a whole separate topic. But so we'd be watching this real time volume rate, and you go, Mike, look at that. And I go, what? Look at that volume. I don't see any volume. He's like, that's right. It's playing possum. They're playing possum. They're just accumulating it slowly. They're working this. Now, he never told me, but he was probably also lots of these things. He was talking to all these big clients. They were talking to him. They wanted to talk to him. And they were paying millions of dollars in order flow and stuff a year to be able to talk to Bill, and it was a big deal. And so the information would go both ways, and he would always pick up on these really fascinating things, and because he'd been around the block. And so I would pick up on those things. So he would say things like they're keeping that volume down, and it just kind of was in the back of my mind. And I paid attention to every word that dude said, like every single word, like it really did, and tried to figure out everything that he was saying. He wasn't always right. No one's always right. But there was nobody better at the market, as far as I'm concerned, and he wasn't always right with that either. But it was no one ever is. And just remember that. Just remember that it's very important for yourself too, because you're going to be hot, and then all of a sudden you're going to be cold, then you're going to be hot, and you're going to be cold, and don't take it personally. That's just if Bill was hot and cold, then it just gives you a comfort level. Gives me a comfort level because I saw like all the warts and everything. I was like, he's still the best, but he made a lot of mistakes, and so it makes me feel better when I make 51 and a half mistakes a day. So playing possum would be one thing. So people aware of not trying to push up that volume. So if you were doing that, let's say these days you're in there and you're buying a bunch of cues, let's say, and you got these veterans act like novices. The way I see it, man, look at a chart, study a chart. And I'm being nice. I really am. Because they're telling me that I don't know I'm talking about with the volume. So man, don't play that game with me. I'll be nice, but don't tell me that. So they're looking at the cues. They're like, these people who don't understand stuff, the, that volume rate on the cues is going up there. Let's just go buy in a futures market. Let's go buy some. Let's buy some calls. Let's buy some QLD. Let's buy some TQQ. Let's short some SQQ to get that same exposure. Lots of different ways. Or let's go in and buy SPY and look at the correlation. And say, okay, well, how much of that is correlated? And okay, well, if I match a SPY with a SMH with a XLK and whatever, I can still get to my Q thing. Like there's a million ways of keeping that volume down, or there's also a million ways of getting that volume up high. If you want, let's say let's do the opposite, not a possum. You've got, I'll wrap it up with this one because we've got so many other things to do. Let's say you're that guy or girl who is saying that the charts are your footprint. So you can manufacture a base. Think about it. You got enough money, you can manufacture a base because you can, and you know that there is those cups and handles people out there, and they like the cup a certain way, and they like the handle a certain way, and not too deep and not too shallow, and no wedging. And so they go in there every day and they're buying and selling at certain levels to get it to look that way. Now they've got this big position. The stock is in this base, and they've accumulated, let's say, 1 million shares, and they want to bring that down to 100,000 shares. So they got 900,000 shares they need to blow out. Well, they start blowing that out, that stock is going to roll, and then they're toast. So what are they going to do? Maybe not the most ethical thing, but I don't think illegal. Push that stock up through the breakout, right? Let's say it's a cup with handle and the pivot's 51 and a half. And it pushes it through there as it's going through there. But let's say again, they have 1 million shares, but they really want to bring this down to 100,000 shares. And they go in right at the pivot and they blast in and they buy 50,000 shares at the market, and then they sit on the bid with 10,000 shares and keep on pushing it up. So now everyone out there is looking at it going, oh my God, there's a big buyer in there. Let me jump in front of them. So they're jumping in front of them. And this person with 1 million shares with more that they're buying, so that now they've got 1,000,001 maybe, that they don't really want those shares, but they want to get this bull rolling. This train kept on rolling up. And so it is moving up, and they're like, oh, I can hear my train coming. And so it's going up there. Now those ducks are quacking, and this portfolio manager uses this momentum that he or she created to sell into. You don't think that happens? Look at a chart, study a chart. we'll do that on it's most obvious on the ones that stair step down. We'll do an episode on that because when you see that, you'll be like, oh, I get it now. Of the getting trapped. Oh shoot, I gotta share it. I just have to, because it was such a good example. Let me share the screen again. I Yeah, this Mongo is a great example of it. Let me just move this over. So think about it. You're in there and you don't like the stock anymore, and you break it out of this base up here to just sell into, but you don't get everything done, and it's down to this level here. You're like, oh man, if I keep selling and pressuring it here in a big way, this thing is gonna break wide open. But you know what? Too late. It's already going down. So then you stop selling, and it's tight in there for a few weeks. Let me blow this up a little bit more so you can see that a little better. Okay, so they're buying it in here, pushing it up, selling it. Now it's in here tight because they've stopped selling it on balance, but everyone else is still doing their stuff, so it's still moving around. Then they try to get it back up through the 200-day because they want to unload more shares, but they're only one person and they can only get it up so much, and then it runs into resistance there, and then it breaks wide open on this day because now the person's like, shoot, I had 900,000 shares to sell. This thing started breaking on me. Let me get as many shares sold this week as I can because this is an earnings week again with that earnings thing going there, so it magnifies it. So now they're selling those shares into this because even though it's breaking wide open, at least there's liquidity there because you always have this liquidity on the earnings, as you can see with the big volume spikes. That the big volume spikes that you see there. Then the same thing happens over and over again where these bad breaks, they're waiting to unload. So you can, I mean, it just jumps out off the chart at me. Here, 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 to a lesser extent here because it's running into something here. Now it finally changes over here, or they just decided to not sell that time in hopes that it would lift up. And that's how I interpret that someone being trapped into a stock. There's another stock that someone kept on bringing up that reminded me of this path of someone being trapped in it, and someone really liked it over in here, and I'm like, just wait for it to get back above here and form a base, or maybe even above here and form a base and actually hold. So then you know that the seller is truly out of there because I think someone was trapped in it there at the 200-day, tried to sell some there. I got trapped there. Were trying to sell as many as they could on that earnings announcement. Just study earnings announcements and the volume with it. And again, in here, they sold into it here, right? Again, no coincidences. This is all happening around earnings. Um, that was actually a constructive earnings announcement right there because it happened and you didn't have a lot of volatility. But then again, they were just selling it in to there. So just always keep that in mind. You can do this through a million charts of just someone being trapped into it, and don't get sucked in to that. Let me stop sharing. Man, this is why I didn't want to do. I was scared about this episode because there's so much going on. We were all over the place. When I listen back to this, I'll kind of see where we need to go next. I'll also listen. I'll look at your comments and see where people are having confusion and try to talk more about that. So if there's a common thread of like they're confused about you guys are confused about one topic or another portion of this, put them in the comments, and then I'll try to focus in on that because this is a kind of one-way street. Like to me, this seems so obvious, but then I've been thinking about it for a long time, and I also understand the market mechanics. And oh my God, there's so many things I want to talk about, and that each thing will just take forever. So let's summarize as much as we can. I have a theory that I'm trying to share with everyone. And why am I trying to do this? What am I going to get out of this? nothing but grief. Nothing but grief. All I get is people being like, well, yeah, Mike was really smart and he's added a lot to the system, but he's all wrong on this volume thing. Volume does matter. I'll say it again. Stop saying I say volume doesn't matter. Volume matters so much. I just don't have a way of saying how clean the volume is. The more you think about this and the more you peel back the onion and you peel back the onion and that peel is a whole onion in itself and you start peeling it back, you're like, the only thing I know is volume is dirty. I don't know by how much. Is it 1%? Is it 50%? Is it 75%? It's an unknown. So the way I approach it is I just don't use it. I don't use it when it makes my case. Sometimes people will say, oh, well, look, there's a lot of volume. I know you don't really care for volume, but look at all that volume. It's typically on earnings. And I'm like, oh, God. But, or on a breakout. So again, think about it. Your big fund in there and a stock is breaking out. Even if you don't believe in charts, you understand charts and you understand where a bunch of people are going to buy it. You might pressure that thing up with a lot of volume to get that volume. So everyone's like, oh, there's volume in there now, only to turn around and sell it. And look, I've been trapped in a stock before, not in a big way, a big, huge, massive fund would be, but in a way that I had too much size for a stock. And if I kept on putting that pressure on without thinking through it, I would have broken the stock wide open and been there in a trapped feeling. And in fact, Bill was that way back when he was in, I think it was both Price Company and Pick and Save, where he had so much of those. And those are ones that he held for a long time. I remember him telling me that, like, he's like, Mike, I had built up, I think it was like, was it Pick and Save that was a 5%, or maybe it was both of them, but that he had owned 5% of the company or almost right up to 5%. And I think there was like, if you own more than 5%, then he was going to have to do some stuff like disclose it and some other um, restrictions or something on him. And so he would own just underneath that, but it was thin. And if he wanted to bail, then he was going to break that thing wide open. He was aware of that and he was scared about that. And I think that really changed a lot of his trading, because that was, you're talking in the 80s, and he morphed a lot. And then that was back when he was doing small caps. And then he eventually was into the mega caps and large caps for the liquidity reasons, to not being trapped, because he was hyper concentrated in just stocks. When he was trading Price Company and Pick and Save, he was 200% long, but those names, like all in and on full margin, which don't do that. Don't do that. Yeah, don't do that. But so he was aware of being trapped. So he understood the market mechanics of things back in the day, and that's why he adjusted how he traded and the size that he would have in anything thin. And me, whenever I ran the size money that he ran, obviously, because it was a subset of his account of his wealth. But I was trapped in things and then really paid the price, and then learned, like, oh wow, you've got to figure out ways to get out in a graceful way. And the easiest way to put it is, and an old one of the PMs back in the day, Lee, would say this thing, you got to feed the ducks when they're quacking, and other people say that too. And it's an old saying that when there is volume there, it's my daughter, I got to take this. Don't go away. Wow, I'm back. I'm just looking at the time. It's already 7:00 at night. What a pleasant surprise getting that phone call from my daughter. And so where was I? I think I was talking about the ducks quacking. The old thing that Lee used to say, and it's very important. It's that because you got to stop thinking about trading the size that you're trading, assuming you're trading normal size that any one person would trade, and think about not trading a lot, trading a ton, like 100 billion plus, and what those people, the situation they're in, that they can't sell when they want, they sell when they can. And so sometimes that'll be when they don't really want to. Let's say the stock is breaking, but it's breaking on earnings, so there's a lot of liquidity there because of all the things that we were talking about. There's also the people that play just on earnings or in a news announcement. So they'll go in there and just say, okay, well, there's a lot of volume today. Let's participate. Or as we were talking about, like not being more than 5 or 10% of the average of the volume on any given day. So there's lots of volume there. If a stock normally trades, let's just call it 1 million shares a day, and you don't want to be more than 10% of that, well, you can only trade 100,000. It trades 5 million shares that day, that same stock, then you can trade 5x, 500,000 shares. So you trade when you can, and if you look at that on charts, especially if you go to a weekly chart and you see one of those stocks that are breaking down lower, kind of stair stepping lower, but like a big stair step and then lower, that is someone, in my opinion, that's someone who's trapped in there, and they're just using those liquidity events to get out. Now, there's other people in there too, other reasons why they're selling, but a lot of the selling from mass amounts of money is because of that. And that's one of the things that's changed as well, and one of the topics that we'll talk about for the future episodes on this. If we do it, yeah, we're going to do it, because I want to try to express my thoughts on why the volume is dirty. I really do want to express all the reasons, or a lot of the key reasons, of why I think that the volume is dirty. So we'll do that over a lot of episodes. So again, I know I'm repeating myself, but we'll talk about the ETFs, mutual funds meaning they control so much money now. That's a whole thing. The algos, high frequency traders, foreign traders, pre-market trading, after hours trading, options, futures, all other leveraged type of versions of let's just put it this way, anything other than the actual instrument itself. So if you're trading Microsoft, MSFT, that's the instrument that in theory should only be traded from 9:30 a.m. to 4 p.m. Eastern Standard Time. Everything outside of that and not traded on that symbol is outside of the real price and volume. Because remember, when you're looking at that price bar, that's the price bar of the activity that happened during that normal trading session. But then now you're talking about all this other stuff, or that same stock being traded over in Germany or elsewhere, or in all the other ways, the option market. And so we're going to talk about all that. And really, you don't know how dirty the volume is. There's no way that anyone could say the volume is clean if you have a clue. Now, if you've been traded 5, 10, maybe even 15 years, and you don't get it, you're like, oh yeah, volume is clean. Dude, you get a pass, man. But if you're a professional, you've been trading longer than that, and you just haven't put thought into it, which is no big deal. I haven't put thought into a lot of things. If someone said some random fundamental data item isn't clean, book value, I never look at book value. Some people take it very seriously, and they're like, oh, book value isn't clean anymore because all these off balance sheet, blah, 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 or whatever. Like, it's that's a world that I'm not in. And they did that, I'd be like, okay, well, but I would be that same person who just has never put a lot of deep thought into it because it didn't matter to me. But if charts matter to you, then the data on that chart should matter. And one of the things with the not the Microsoft beta, the market surge beta that we have out right now, that still has tons of bugs. So during trading hours, I would just use the legacy version. I would not use the beta version. But one of the things with that, and that was really, I can't take credit for or blame for the new version of it, because it was really a group effort. I'm focused in on ratings and pattern record growth 250, and I'm just one person I'm one chef of a lot of chefs for this thing. But one of the things that this chef wanted was the ability to turn volume off on the charts, because I'd rather replace that with some of my own indicators and stuff that we'll eventually put in. We'll get the Webby RSI and my Bob Marley and some other indicators that I've created that I've never shared. We'll get those in there over time, and I'll just put them in the place where the volume is, because I don't even look at volume. I mean, my eyes don't even go there. I don't look at it at all. I use it for liquidity concerns, meaning how much volume trades on a given day. So I'll use like $75 million volume as one of my key thresholds, stepping down a bit, all the way down to 25 million. There's nothing magical about these numbers, but you got to pick a level. So is $74 million volume okay? Sure. But then 65, well, then at some, you've got to put it at different levels on there for liquidity. And I talked about in that last any given Sunday with Bill, that Bill's rule was 400,000 shares, but he would deviate from that at times. And that brings me, God, this is like this onion, man. I got to tell you, this will be my last thing for today. So is volume historically over time. So I went and now that's too big of a topic. I'll talk about this aspect of it. That when I did my big base study, what I did is I wanted to exclude and that was in 2013 and went back to all stocks to 1963. And I excluded, depending on different runs that I made with the test, either the bottom 10 or the bottom 20% by dollar volume, not share volume, dollar volume, how many dollars actually floated through there, because I knew that we didn't like trading thin stocks. So I didn't want them as part of my study because then it distorts the end data. Because if you've got stuff in your universe that you'll never trade, then why study it? Then it distorts the stats. Maybe all the best performance comes from those. That doesn't make any sense. So if you're not going to buy a $2 stock, don't have it in your study. So I put the threshold at $10 because was a hard and fast rule. And at the pivot, and then looked at this was automated, but every base, so tens and thousands, hundreds of thousands of bases, because this was dead stocks, meaning stocks that have merged or gone out of business, as well as ones that have still been trading. And from 1963 to 2013 was a big, giant study that I did. But when I was going through it, at first, I was like an idiot. I was like, okay, well, I'm going to put the volume thresholds at, let's just say 400,000 shares or above. Or really, I think originally put it at like 25,000 shares traded or above. And then I look back in time, I'm like, well, can't use that because let's say in 2013, 25,000 was thin. Well, go back 30 years and that was liquid, and go back before that and it was the most liquid, the biggest traded stock out there, just throwing numbers out. And then I'm like, oh wow, that's a big problem. There's no one threshold. And so then what I did is each year I would take the data set and say, okay, for 1963, take all the dollar volume for that and lop off the bottom 10% or 20%, because I did it in two different ways. And for 1963, and we're going to remove those. And then went to 1964, did the same thing, 65, and so on. So it was on a percentile basis. So I either got rid of the bottom 10 or 20%. So I got very comfortable with going back in time and looking at volume and how volume changed over the years and decades. And certainly because I did this big study going all the way back to 1880 and 1880 through the 1963 to fill in that part of the database. And you'd be shocked how thin things used to trade. Back in the day, some of the dirty volume from the Livermore's day would have come from the bucket shops. Anyone who understands that, I'll keep that topic for another episode. But with the normal trading, it just morphed so much. The volume just increased. All the price patterns pretty much looked the same, but the volume itself expanded, the average volume dramatically. And go back and study that in charts from the 1960s and 70s and 80s and 90s and look at how much that changed, because all the money flowing in it's really become a global market. It has really become a 24-hour market almost in a lot of ways. And it's become ETFs and mutual funds and hedge funds and all the other things that we talked about. With all this money, the amount of volume just keeps on increasing and increasing. So to make a long story short, I was doing a project and was showing some charts to Bill for some things I think it was in the 80s and 90s. And I was giving him some some stocks to look at for something that we were working on, and I forget which project it was. It wasn't the week by week base, but it was something else, and I gave it to him whenever I did stuff for him, I took it super seriously and print it out and I bind it and do it all myself. And then, because I wanted to make sure the quality control on it was like good. And I gave it to him and I got this one back and I still have it in storage where it was like, volume's too low, volume's too low, volume's too low, volume's too low, and all of these things. But they were the most liquid names those years. So here's Bill, the master, right? You know, and he can't even remember. And he was fine, you know, there was no issues because this was. So there were no, so he was looking at that and he couldn't even remember. He's like, why is this thing only trades 50,000 shares a day? This only trades 25. You get it out of the sample. If I got it out of the sample, there would be 0 in the sample because that's what liquid names were those years. And if he couldn't get it, then I have empathy for people who don't get it, who don't go and understand how much volume has increased over the years. Just go back, find some old stocks. You can go online and say, okay, well, what were the key stocks in the Dow? You can go on like Wikipedia or Grokopedia or whatever your preferred one is, and go and see like what were the Dow components or the biggest S&P components, and you pick a year, and then go. Unfortunately, our database now only goes to 1984. It really kills me. But find the data, you know, in the 70s and the 60s for those and how much volume it traded, and you will just be shocked at how thin things were because volume was different. Volume was clean back then because there weren't options on stocks. There weren't algos. There weren't ETFs. They weren't trading in pre-market and post-market. They weren't trading overseas. They weren't, you know, all these other things. Spreads were big. Commissions were high. If there was volume in there, it was confirming that price action. Times have frickin' changed. You've got to recognize that or not. I'm just trying to help, man. Just trying to help. And it got me when Bill put out and took a ton of career risk and reputation risk when he said PEs, low PEs were not relevant and PEs weren't relevant. If anything, really higher PEs were better in what he found. And that was sacrilegious. And to a lot of people, even to today in 2026, they still think the lower the PE, the better. Well, no, he would always explain it this way and it always bothered me because I knew what he paid me and I knew what he paid some other people, that he would say, well, imagine, because some people asked for raises and some other people just thought a raise should come to them for doing good work and thought it was polite to just wait. Mike, you're so silly, idealistic and all. But he would say, like, okay, look at a sports team. And he would like talk about the Lakers or something. And he would say, okay, well, who's the highest price person? I don't follow sports. Was Magic Johnson on there or Larry, whatever? Yeah, I don't know these people. I think Larry Bird was on a different team or Kareem. I saw Kareem once at Costco. I got to tell this story. I might have told this story before. I'll tell it short. I'm at Costco in line and he's there with another guy who's tall. And then Kareem is just like super tall. And I don't care about sports. And they're there and they were buying Gillette razors. And I always had the coupon books with me. And I knew that if you bought the razor and the shaving cream, that the discount was so much that it was like you were getting the shaving cream for free. And so they were in front of me and they had that and I knew it was in there. And I wouldn't have cared who was in front of me. I was just going to tell them. And I told them, I'm like, hey, there's a discount on this thing. And they just like looked at me like I was like, why am I talking to you? And I didn't care that it was frickin' Kareem, other than he was like frickin' tall, man. And the guy with him was frickin' tall and made Kareem made him look short. And I looked like a frickin' like I was an inch tall. And I don't even know why I got off on that tangent. I had to pause it to remember I'm getting old, and I'm tired, and it's been a long day, and I got to do this again. It's Monday. What? I shouldn't record these on a Monday. It's going to make for a long week. But anyways, the whole reason why I got on the sports thing was, oh yeah, he would talk about the Lakers and then the different pay, and he would say, okay, well, Kareem is going to get paid, 50% of the salary, for the team, and then the next person is going to get paid 30%, and then you're going to get all these other people getting paid much less, because people are getting paid what they're worth. Well, in theory, doesn't always happen that way, but so that was his way of relating things to PE, saying, okay, you've got 3 stocks in a group, and one of them's got a PE of 150, another one at 50, and another one at 15, 1.5, or let's call it 20. That most people would be like, oh, well, I don't want to buy the 150 one. That's your Kareem. And you don't want to buy the 51 because that's your next person. And then you want to buy the cheap one. Well, that's your run of the mill one. It's being priced at for a reason. And when he explained that, it was like, wow, I might not follow sports, but I, I totally get that when it comes to like a band or something. Like you see, like let's say let's go with Van Halen, right? Well, I love Mikey and all, but Mikey would be the first person to tell you that he shouldn't get paid the same amount, and he didn't end up getting paid the same amount as Eddie, right? Because Eddie is more important than Michael in that situation. Doesn't mean he's a better person, worse person, or whatever, but the value there to that group, like then they were able to put Wolfie in there in place of Mikey, and it was that was an improvement depending on how you look at it from a musical standpoint or whatever, but it was still Eddie. That came out the wrong way because, man, I love Mikey. Mikey's sort of the other half, and oh man, can't go on that tangent. But anyways, it was a terrible analogy, but I understood what he meant by things getting the value that they should from a salary standpoint, and then the same thing from a PE. But he risked his career putting that out there like that because people look at him like, oh, you're just crazy. You're the guy who looks at charts and thinks the PEs aren't relevant. Well, what he did is he looked at the fish tank, and by the models, that was his. Go back to the beginning of this, the whole fish tank thing, if you skipped over that. And he looked at it and said, well, that data item is not relevant, or at least it's not relevant the way people think, that the lower the PE, the better. Now, we did use PEs, but that's in PE expansion, that's a whole different thing, and it does work, but not from a selection standpoint. And so he risked his reputation and stuff by saying that. And when I came to the conclusion, because I'd been thinking about this dirty volume thing for a long time, and it really probably came to a head in like 2015 or so when I was doing my algo stuff. And then it just got bigger and bigger after that, once I started focusing on it. And then it got to a point where I was like, I just need to tell the world because it's not cool not to. But I also understood the risk I was taking by doing that. And I'll just say it pisses me off because I have friends who say that Mike thinks the volume isn't relevant. Let me tell you again, and I'll put this clip out there. You who are saying that Webby says the volume isn't relevant, you are full of it. Volume is super relevant. The volume data is just dirty, and there's no way to get clean data. And that's what this series is going to be about. And by the end of this, you're either going to be sick of hearing about it, or you're going to understand it. And if you have a closed mind, you're not watching this anyways. So who cares? So this is for you with your open mind. They're watching it, and I appreciate it. And let me just tell you this, because we're wrapping it up. I really sincerely appreciate all of the kind, very, very kind comments that I get in these. It's really keeping me going. I don't have time to do these, but I'm on a mission. I really want what's in here to be put out there. So for my grandkids, future grandkids, I don't have grandkids yet. My daughter who just called, her and her twin are 24. They have no plans of having kids anytime soon, but I don't know if I'm going to be around when none of us know. But I think there's a strong likelihood, I just want something documented for them. Let's just put it, we'll just put it in those terms for if my kids ever decide at some point in the future that they want to learn how to trade, I wanted a series of everything the full Webby rambles on. It's for my kids and my grandkids and future grandkids if they ever want to learn how to trade, because as I've told before, someone came to me, a legendary trader asked me for a favor to teach one of his kids who was an adult, who was older than me, who was thought to know how to trade, asked me to help that person learn to the level that they should. And I did it, and it always stuck with me. And that person didn't know it, that I was asked to do that. And I was happy to do it. I would have done it just like the Kareem thing. I would have, when I was talking about that, and I would have helped out anybody in front of me. That's just how I roll. And he didn't appreciate it. Whatever, dude. It's your problem. And nor did his buddy. But anyways, is what it is. But you know, trying not to just keep going, but I'm trying to put this stuff out there for them and for you guys. For you, I'm clearly going on too low a sleep. So he had asked me to help this person out, and it always, and I did, and taught him everything that that I could teach him, and that it always bothered me. I'm like, wow, man, I would hate for someone. I'm never gonna my kids or grandkids, and if I was around, like there would be nothing there's nothing that would bring me more pleasure than to teach them. But I don't know if that's in the cards. So that's why I'm doing these, is to have that record there so they can learn from me. And so you guys are all benefiting from this, and it's a dual purpose because I really like helping people. And I believe in karma, and I just believe in helping others. And so I'm putting this out there. So there's no upside to me in doing this, zero, only downside. So at least don't alter what I'm saying. Volume is extremely important. It's just there's no way to determine clean volume in most cases. There are some cases, and we will talk about that in future episodes, of which volume I do think is relatively clean. So that would be in future episodes. But again, put your comments, keep up with the positive things, because it really keeps me going, because these, I don't have time for these. I really don't, but I'm really trying to get this full message out there, and they really help a lot. Any negative one negative one, is like the same as like 100 good ones. So don't be that negative one, man, because I don't like, I come at you. Like if you put a negative one, I'm coming at you, unless it's valid. If you say I don't know, something that's valid, I'll own it. But if it's not, I'm coming at you. Just fair warning. Got to keep it balanced and all. It's not 1984, it's 5150. Okay, enough with that. So with that, every one of these episodes, we've got to do what? We've got to do a kind act. That is what I asked from you. If you've watched any of the other episodes, everyone, you're on your on the honor system to do at least one kind act. You can do more than one kind act. You can do them kind acts all the time, but really think through and go, I'm doing this kind act for Webby. And that'll get you thinking through of just being, and it could be small, could be big. People put in some really cool things that, what was it that someone helped, like in the snowstorm, I think it was like Boston or something, like 9 of his neighbors or something helped out with the stuff. And then other people have gone to like food banks and like just wonderful things that I'm hearing. And these are things that may or may not have happened without this series. So I'm really trying to make a difference, and we can all make a difference. And it's just try to do a positive thing for every one of these episodes that you watch, and just try to share these. Go on Twitter. My handle is mwebster1971. Tag me on it, share it, retweet it, whatever. Really, like, it's really sad that I did that one about Any Given Sunday with Bill, and it didn't really get many views. And I really thought, man, like, if anything would get views, it would be that. Well, not the first half, but the second half of it. And it really didn't. So I guess whatever, it is what it is. I need to figure out how to do these better, but like just getting this out is enough. So with that, think it's time for me to go get some freaking dinner. So peace out.